finally coming down in price.
John, what do you think? Is value in it these days or growth out?
Well, it seems to be for the last few quarters we have seen value stocks really outperforming the growth stocks for a number of reasons. The growth stocks, at least in the healthcare area, the pharmaceuticals, some of the medical device companies that I focus on, some of them are down more than 30% off of their highs. And it is less so to do with any sort of a fundamental problem in those sectors, but more so to do with the economic sensitivity of those earnings. The earnings are very predictable in those areas, yet when Alcoa, International Paper, and the cyclical stocks can show accelerating earnings growth, those valuation parameters can swing fairly wildly, and that's been the real cause on that.
Well, hasn't there been a worry for some of those healthcare companies that some of the large healthcare companies face their patents running out in the year 2001?
Yeah, the patent expirations, each industry participant in the healthcare and pharmaceuticals does have the patent issues to face. There are a few large drugs that do go off patent in the year 2001, 2, and 3. But in the structure of our portfolio, we think that we have designed the holdings such that we really won't be hit by that. So individual companies have risks, but that's not necessarily a negative for the industry.
So you think people should be staying with some of these pharmaceutical companies?
Absolutely. If you have the discipline to look at those companies that have good growth driven by volumes, new product introductions, and are patient with the names, I think that right now we have some very good opportunities.
Garrett, you look at emerging growth and growth stocks. Tell us the difference between emerging growth and growth.
Well, emerging growth, really, Maria, we focus our emerging growth efforts on new companies that are new, vibrant industries. So industries like the internet or technology, some in the healthcare area, really are areas where we focus. These companies are smaller, they're a little bit younger, they're new to their products, new in their market spaces. The exciting part of the U.S. economy, at least we believe that.
Well, that's an emerging growth, you're saying?
Right.
Do you consider a Yahoo an emerging growth?
From a business perspective, I do. I think it's a demerging growth as far as stock price, but I think from a business perspective, Yahoo, AOL, Amazon are very young companies. I think they're going to be around for many years. I don't know if the stock prices are going to
Certainly
continue.
The market capitalizations tell a different story.
The market capitalizations would tell you that they've already gotten to the point where they're S&P kinds of names, but they're very young in their business cycles. Those are the kinds of companies generically that we're looking for.
So you like emerging growth over growth?
I do right now. I think that the market is turning back toward our way. We've been sort of in a bear market in the small cap growth stocks since about the middle of '96. We started emerging, frankly, out of that period in about September, October, when the Fed started cutting interest rates and have had a pretty strong fall and a good winter in that group.
Ron, you said that it's not over for the growth companies. What specific stocks do you like or sectors do you like in growth?
Well, I think the late 90s is going to be representative of the early next decade also. There's four main areas where you find growth. It's technology, healthcare, the consumer sector, and the financial services sector. So that's where you have got to do your hunting. Technology will probably be the fastest growing sector. We're in a revolution now that's called a technology or a data revolution. It's real. It will be bigger than any industrial revolution that we've seen in the last 100 years.
Do you, like Garrett, like the internet companies?
We do have some internet companies. We think the stock prices got ahead of themselves, but it's a tremendous force. It's going to affect every business out there, including consumer, industrial, and it's going to set the prices for the future now on goods.
John, we mentioned pharmaceutical companies, and those are the stocks that you like. What about all of these drugstore.com type companies? Do you like them?
From a business plan, I'm not yet really comfortable with what their strategy is going to be to actually show profits. One of the disciplines that we have is ultimately we would like to see our companies show a little bit of profitability. Within healthcare...
Profitability,
within healthcare, there has not been a lot of merchandise in the internet names. We've only, until recently, seen Healthion merge with WebMD. I believe Amazon does have drugstore.com. That will be coming public over the next month. And I think the only other name that's worth mentioning is On Health Networks.
Well, what's the big potential there anyway? I mean, don't you think that a person needs to go to the doctor in order to be prescribed something? I mean, certainly you can't do everything as far as medical is concerned on the web.
And that's the fundamental issue that a lot of people like myself have been asking. How do you remove the physician from the loop? You still have to go to the physician's office to have that prescription filled. You still need to be able to go to the pharmacy. If you have an antibiotic, I don't think you want to wait a few days to have that show up at your house. You need that right now. If you have something that's more chronic care treatment, then perhaps something where you can be a little bit more patient, wait a few days for that prescription to arrive. in an environment like that, internet stocks or drugstore.com might actually work.
Okay, we're going to take a quick break. We're going to get a lot more ideas when we come back, and we'll look at some traditional growth sectors to see whether they'll measure up this year. Stay tuned for much more of our special program, the Investment Summit, the Los Angeles Times Investment Strategies Conference, right here on CNBC. Welcome back to this hour of our special program, the Investment Summit, the third annual Los Angeles Times Investment Strategies Conference. I'm Maria Bartiromo. Joining me once again for this hour to speak about growth stocks for the new decade, Ron Ogner, portfolio manager of the Strong Growth Fund. Next to him, John Schroer, manager of the Invesco Health Sciences Fund. And on the end, Garrett Van Wagner, portfolio manager of the Van Wagner Emerging Growth Fund. We are going to now look at small versus large cap stocks in the growth area. Now, Garrett, you're investing primarily in some of the small cap growth stocks, but small caps up until just recently haven't really performed very well. Do you think that's changing?
I really do. I think actually the way to phrase it would be they performed miserably from about mid-96 till September, October of 98 when we started getting those Fed rate cuts. We've seen in the fall and the winter a big pickup, and it's very noticeable in the markets now. Some of the traditional, particularly in the technology sector, traditional names like the Dells and the Microsofts and the Intel seem stalled, where some of the smaller companies are really starting to perform. And I think that's something that's going to continue.
But haven't we heard that this is going to continue forever? It seems like for so long people say to me, people will start rotating into the small cap names. Large caps are done. It's the small cap time. It really never stuck. Why now?
I think that we're finally starting to get some of the momentum relative to earnings that's really helping. I think some of the bigger companies, the earnings are slowing down a little bit. Dell seems to be slowing down a little bit at the margin. Intel, so which drives the technology sector in particular. So the money's starting to look for growth, which some of the smaller companies can provide. But you're right, people have been saying it for 2 years, and I think just about when no one wanted to believe it, it's starting to happen.
John, what do you think?
Well, within the healthcare sector, we have seen the larger cap companies dramatically outperform most of the smaller companies. And I think it is less to do with just a flow of funds issue and more to do with the fundamental structure of the healthcare industry. That which is required to have critical mass to successfully compete and to be able to commercialize products, you have to have very large companies that have the financial resources, the regulatory experience, the clinical experience to be able to launch these products successfully and to be able to do that on a global basis. So it's not just the smaller versus large company discussion, it's more of what is truly required to be structurally competitive in this industry. Over the next year or so, you are seeing some deceleration of the larger company earnings relative to the smaller companies. And so that has, as Garrett mentioned, has been the biggest explanation of why you're seeing the smaller companies do a little bit better in the near term. Longer term, my feeling is that the larger companies will still have that critical mass. The fundamental structure of the industries have not changed. So to be competitive, you still have to have that larger ability to successfully launch these products.
So over the near term, would you be investing in some of the smaller growth companies in healthcare?
Where there are opportunities, where companies can show a clinical benefit of a product, we have looked at some of these companies and have made investments. However, with the portfolio design right now, it is still mainly larger cap.
Which companies?
On the smaller cap side, we've looked at some companies which were briefly small cap. They've dramatically gone into being larger cap. One name is Vizix. They are the manufacturer of what many people have seen as the laser surgery techniques to correct vision. And that's probably one of the companies we've looked at recently. A lot of the biotech companies we've looked at, such as Gilead and so forth, these are companies that do have a lot of new products that are on the cusp of being approved.
Ron, you disagree. You're not in any healthcare, yes?
No, I don't disagree, but we've limited our health care for the time being, just as long as the government's involved in attacking the pricing. We'll come back to health care later because the demographics are so strong that more and more health care has to be given to the aging population.
So what are you doing in the meantime?
In the meantime, we were heavy in large cap stocks for the last 12 to 15 months. But we brought it down to the mid cap arena, and that's $1 billion to what we think is about 11 or 12 billion in size. We think that's where the action is going to be. Some of the small caps will perform, but it's interesting, the best of the small cap grow up to be mid caps very quickly. Within 2 or 3 years, they're jumping right into mid cap class. People still want liquidity, and money managers, especially in the big funds. And I think when they're coming down from the big stocks and diversifying more, they'll buy the mid cap stocks first.
Okay. Garrett, we spoke about healthcare companies on the web. One of your top holdings is On Health Network, which is a website devoted to healthcare. Tell us about it.
Well, they've got an interesting approach, Maria. They're really trying to develop proprietary content. We look at a lot of the so-called content providers, healthcare or non-healthcare. They're really reconstituting current content, meaning they're going to magazines, scanning in articles, and building up large databases. On Health's approach is very different. They're actually developing their own content, working along with people like the Scripps Institute, the Cleveland Clinics, and people at Stanford, creating their own content. I think if you look at healthcare or you look at any area when you're creating a media property, which these internet stocks are, proprietary content is really the way to go. If you look at the way magazines or television stations were built, really, where they really gained their ramp was the fact that they had something that no one else had. And On Health's approach is very much in the proprietary area. Some other people are now sort of coming around to that, but most of their competition is just reconstituting available healthcare material and trying to get some critical mass, and that's why we like On Health.
There have been quite a few healthcare companies which have come to market recently, healthcare on the web. Do you think all of these companies will survive, or will we see consolidation in this area? Who's poised to
Sure.
outperform?
Yeah, I think we're going to see a lot of consolidation. I don't think all of these companies are going to survive by any stretch of the imagination. I would say that's generally about the web. We're in the mania phase of the web right now, where we had limited supply of product, Wall Street product, and the investment banking community is doing an excellent job of providing more supply to that demand. Not all that supply is going to stay. I think there's a lot of companies that you need to avoid on the web right now. Any company that seems to tell you they can lose more money than the next as a way to get their business going probably is not a great investment.
Our audience agrees.
So we're looking at that, but in the healthcare field, I think that's going to be like any other field. You have to be very careful of their strategy and just think of it in a common sense basis. Would you lend your uncle or brother $10 to get into that business? And you would say, no, don't invest in those internet companies, because the same result will happen. You won't get your money back.
I want to talk a lot more about that later in the show, but John, let me ask you, Merck is one of your top holdings.
Yes.
Why do you think the stock has traded down recently?
Again, I think it is more to do with the pharmaceutical industry, where many of the names are down almost 30% off of their highs. Merck actually has somewhat outperformed the others in that it has lost less. Now, I know that's somewhat of a Pyrrhic victory, but the company, there continues to be some worries about their major products. They do have some products that are going off patent in the year 2001, 2, and 3, but in the near term, I do think that Merck is an opportunity to acquire the shares because of the launch of Vioxx. That's a new drug for the treatment of osteoarthritis and pain that was just approved on Friday.
Right, just approved.
And that will be a competitor in a market where it's one of the largest drug markets in the world, is the treatment of pain and osteoarthritis.
We're going to talk more about catalysts to move those drug companies later in the show. We do have to take a quick break, a short break. When we come back, we'll take a look at how healthy some high-growth tech companies will be in the future. Don't go away. We return in 2 minutes. Welcome back. We're continuing our discussion now on growth stocks for the new decade with 3 top growth fund managers, Ron Ogner, John Schwerer, and Garrett Van Wagner. Gentlemen, we cannot not speak about technology companies when it comes to growth stocks. So let's talk a bit about some of the big tech companies. Ron, one of your top holdings is Cisco, but you're light on PC stocks. Why is that?
Cisco's always been one of our top holdings. As a company that went public in 1990, became the leader in the networking field. And now we think it's long on its way to becoming also the leader in building the infrastructure for the internet business that's going on right now. In addition to that, they get about 70% of their orders over the internet, so they're using the internet. and that's a tremendous cost savings for them, and it really allows their customers to really be in contact with their company and their supplier on a daily basis.
Why are you light on the PC stocks?
PCs are becoming a commodity. We were heavy in Dell computer. We still own some Dell as the leader. But when prices start to become like TV sets now, under $1,000 and going towards $500 per unit, too much competition, margins are shrinking.
Garrett, you have technology companies in all three of your top holdings. You're focusing on tech, but they're not the larger names, correct?
Correct.
What do you own?
Well, we like the smaller names. You know, one of the things we're seeing is this market rotation. If you look at what's happened over the past couple of months, as I said earlier, the Dell, Cisco, Intel names are having trouble getting going again, and I think that money is moving down the food chain. Areas that we like are particularly in the communications area, where we still think there's a tremendous amount of growth. Some of the chip stocks that feed into that communications area we like quite a bit. And we're trying to avoid some of the old favorites, the old leaders, which we think are going to mark time for a while.
Do you think that the PC sector is slowing down and that PCs are becoming a commodity as well, like Ron?
Well, I certainly think that we're in the seasonal slow period for PCs now. I do think that the market is bifurcating for PCs. I think the low end is going to head toward the commodity orientation. I think there is going to be a high-end business PC market that's going to be more feature rich, that maybe you'll be able to scrape out a decent living in, but certainly the low end of the retail business is going to get very, very competitive. And frankly, if there is one sector that I'm worried about relative to Y2K, it's probably PCs. I think that there's been a lot of corporate buying at the beginning of this year to make sure things are installed for that period, and perhaps the second half of the year we won't see the normal uptick from the business market in the second half of the year.
Let's talk about Y2K. John, do you see the Y2K problem affecting your investments?
It's something that we have spent a lot of work trying to talk to the companies. One of the areas that we are concerned about is the prospect of drug hoarding, where individuals that have prescription drugs, chronic medications, whether it's insulin, stomach medications that you might have for ulcers or so forth, will go to their physicians and ask for 1 or 2 extra prescriptions in the fourth quarter. And so, although it doesn't sound like much, a prescription is 1 month. That could add potentially 30% to your demand in that quarter. So we're trying to very closely monitor how is the industry going to deal with this, how will the pharmacies deal with it, and how will the drug wholesalers deal with it. It will be something that I anticipate you will see accelerate revenues in the fourth quarter. So the real key for an investor is to track those companies and differentiate between what was core, real revenue growth and what was the additional bolus that you have from that. So that's going to be a very important question, especially as that first quarter is reported and people don't reorder that drug, they just use it again.
Ron, what about you? Are you worried about the Y2K?
Not really. I think most major companies in the United States have taken care of the Y2K problem. They're all in the testing phase right now. We're going to get a good look at it in September when we have 9999 date that has some of the computers programmed to. But the worry is more the governmental or the foreign company suppliers that might have to deal with some of the companies.
Now, you mentioned the build-out companies, the Ciscos. Are there any other companies that you see benefiting sort of like from a back door to the building of the Internet, in addition to Cisco?
Oh, there are many, and they're popping up all the time. And a lot of good companies have a small piece of the business, but another area we should not take our eyes off is the communications business and telecom that's gone worldwide. So I think companies that feed equipment and software and services into those areas are going to be the real growth areas.
Speaking about telecom and media, Garrett, one worry on investors' minds with regard to AOL was that AOL would be boxed out of this push to offer high-speed access to the Internet. What do you think?
Well, I think there's going to be high-speed access to the Internet. I think people are going to demand it. If anybody out there has high-speed access, once you get it, you don't want to go back. I think AOL's aware of that. They're developing a broadband strategy, and I think they'll be fine. I'm not really worried from that perspective on AOL. I think they'll figure out a broadband strategy and one in time that won't hurt the company. As far as our investments, we're focused quite a bit on that broadband access and strategy. A lot of the companies are still small, thank God, and we've had a number of investments in that area.
What are some of the small cap ideas in that area?
Well, in the CLEC area, which is some of these new telephone companies, there's some what's known as data-only CLECs that are providing this high-speed access. There's a new one that just came public a couple of weeks ago called North Point we like quite a bit. We've had a large investment in Covad, although it's a little smaller now given the rise, as well as several others, but those two would be two of our favorites.
Okay, we'll get more ideas later. We do have to take a short break, but when we return, we're going to start taking questions from our studio audience. Stay tuned for much more of our special program, the Investment Summit. Don't go away. Welcome back to this hour of our special program, the Investment Summit, the third annual LA Times Investment Strategies Conference. I'm Maria Bartiromo. Joining me here at the LA Convention Center once again to speak about growth stocks are Ron Ogner, portfolio manager of the Strong Growth Fund. Next to him, John Schroer, manager of the Invesco Health Sciences Fund. And on the end, Garrett Van Wagner, portfolio manager of the Van Wagner Emerging Growth Fund. We have to take some questions from the audience now. We have a lot of people waiting up, lining with some questions. Our first question to the right. Yes, sir. What is your question?
I'd like to know the process you go through to pick a stock and then when you know when to sell.
Okay, Ron? We all do. Ron, why don't you take that one?
Okay, in this age of technology, most money managers now, we say we're bottoms-up stock pickers, but we do a lot of screening for companies that are showing the numbers, the results we want to see. Then you go out and investigate them. At other times, you go to conferences, you meet the managements, you hear a presentation, or you want to get into a certain industry and you analyze the best companies in the industry. That's how we do it. As far as selling, there are about 3 reasons to sell. One is the fundamentals just start to sour on you for that company, and you have to get away and move on to something new. The second would be valuations get so high and ridiculous, and let's say some of the internet stocks where you just had to take some profits. Many of these new IPOs that are coming, the professionals are selling them first day, and I think a lot of the public is buying. That's a mistake. The third reason would be when the Federal Reserve really raises rates and causes a bear market, then you've got to sell some of your holdings to bring the beta of your portfolio down.
Are we in jeopardy of seeing a real rise in interest rates at this point, now that the Fed has moved toward a bias of tightening? Why don't you take that, Garrett?
I'm very carefully monitoring the situation. I think that the Fed, now that they make a statement almost instantaneously, it's become a political statement, so I'm not sure what they're trying to say. When they did that, they were out in the market in a Fed operation doing a coupon pass, which was adding liquidity right when they were going toward a tightening bias. So their actions were not aligned with their speaking. But if they start raising short-term interest rates, I'd be very concerned about this market.
Once, or do you need to see it a couple of times?
Oh, I only needed to see it once.
Okay. John, do you follow the same rules as Ron when picking stocks and when deciding when to sell?
Yes, the process that we follow is very much of a fundamental approach. We do a lot of trying to kick the tires, go and visit with managements, try and talk with clinicians in the industry, and really try and understand the products and what that life cycle might present for an investor. On the when to sell aspect, which is obviously, that is perhaps the most difficult question for money managers, the things that I look for, typically when you have made an investment, there will be 3 reasons at most why you own this company. If any of those reasons change for the negative, that's generally a reason to sell the stock. If for whatever reason you bought the stock for a certain growth of a product and that's not happening, the biggest flaw or trap managers fall into is when they buy it as a growth stock, the reasons don't happen, and then they own it because now it's cheap.
So you have to constantly monitor your stocks always. Now, quarter by quarter, every time they report, or even more frequently?
That's our contact with the companies are more frequent than that. We have that report card that comes out quarterly that should validate our investment thesis. However, our investment horizon is not just quarterly, it's much longer than that. We're looking at product life cycles that should be 5-10 year life cycles.
Let's take another question. Miss?
Yes, this is for the whole panel. All of the stocks and recommendations you've made have been for U.S. companies, I believe. What are the emerging trends for the global market or the international market that you would recommend?
John?
Many of the healthcare companies that we own, which are listed in the United States, also have very large components which are international. The U.S. companies in healthcare are oftentimes the dominant companies globally. So you look at Guidant, Medtronic, Merck, Pfizer. On average, the companies that we own have about 35% of their holdings, 35% of their operating income sourced outside of North America. Some companies that we do own, such as SmithKline Beecham, that are located in the UK. Those are a few of the international names.
Ron, are you buying international stocks?
We do very few international. We do some, though, that are leaders in their field, like a Nokia or a Tyco that's now based in Bermuda. But I think the emerging markets are turning around and getting better, but I think you want to leave that up to the professionals that concentrate only in those markets to really know those stocks.
Garrett, the rules are different when you're investing in international stocks as far as versus U.S. stock guidelines, yes?
Well, yeah, the accounting practices can be different. Your access to management is almost zilch. Frankly, it's very difficult. There's time changes, there's language barriers, there's cultural barriers. There's an old expression in real estate, when you're from out of town, you're from out of town. And I think that's true in international investing. You have to be very careful when you're doing your research. It's hard to get good research. We focus, it's hard enough for us in the United States. We don't venture past that.
So would you guys all agree that you want to stick to domestic companies?
Well, we do only because that's our job.
Right.
There are some international opportunities. I agree that emerging markets could be interesting, but that's not our...
John?
Our focus is primarily in the larger domestic companies.
Okay, Ron?
Just as I said, let the professionals that run international funds do that investing for you.
Okay. We have another question on the right, sir.
Thank you, Maria. John, would you discuss Cigna Corporation, please?
Yes, Cigna is a large healthcare health company involved on the insurance side. They have some property and casualty and some other non-healthcare related businesses that they are in the process of selling and spinning off. So primarily what you are left with Cigna will be a health insurance company. The majority of the earnings are driven by the HMO. We do own Cigna. We're looking at a turn in the HMO industry that is just at the very beginning. We're starting to put our toes in the water, and Cigna is one of the names that we do own. There is a lot of leverage on the income statement at that company.
Okay, we're going to take a quick break. When we come back, we will take more questions from our large studio audience here at the Los Angeles Convention Center in Los Angeles. Don't go away. CNBC returns in 2 minutes. Welcome back to our coverage of the Los Angeles Times Investment Strategies Conference. I'm Maria Bortiromo, joined today by 3 top growth fund managers, Ron Ogner, John Schroer, and Garrett Van Wagner. We have a lineup of people wanting to ask questions to these 3 fund managers, so we'll get right to it. What is your question? Yes, sir.
Hi, I'd like to know about 2 high-tech companies, one being Wind River Systems, the leading provider of operating systems for the post-PC era, and the other one being Qualcomm.
Okay. Wind River Systems. Do you know it, Garrett?
Yeah, I think this gentleman owns some shares from the way he described them. That was as good a tout as I've heard in a long time. They provide operating systems. They're competing right now with this little guy named Microsoft and something called Windows CE. I think Wind River Systems is a very good one. They're dominating a couple of niches and probably can hang on. The stock had gotten absolutely clobbered. It's recovered about 50% or so. We owned it and traded it, and we're all back out again. I'm still a little concerned about the CE business, but it's a pretty good company. Qualcomm is in the CDMA business, wireless communications. They're doing a good job in Korea, and that's about all I know about that one.
Ron, do you like Qualcomm?
It's made a tremendous recovery here and really advanced in price. I'm not sure it's a buy right at this level, though. It's expensive.
Okay. Let's go to our next question. Yes?
This is for Garrett. Are any of your funds participating in IPOs?
Yes, they are. All of them are. I think that we're not any different, unfortunately, than any other mutual fund company. Wall Street has the sell side that are providing the IPOs has a wonderful mechanism of allocating these hot deals so that everybody's upset when they get their allocation. If you call any of the brokers or know anybody that's in that business, their worst nightmare is the day of a hot IPO because every one of their clients is calling complaining. So although we get some, it doesn't really have much overall impact on the portfolio, unfortunately. We're a little bit small to really command much attention from a lot of the big brokerage firms.
Next question, sir.
This is for everybody. When you sell a position in your fund to make your fund look attractive, don't you think you hurt yourself in the long run?
Excuse me, what is the question?
When you sell a position in a company to make your fund look attractive,
Window
don't you
dressing.
think you may hurt yourself in the long run?
He's referring to
This is
window
for
dressing.
everybody.
So
Okay.
if what you're referring to is the practice which is called window dressing, so you have names which you presumably would sell on the last few days of the quarter so it doesn't show up in the... That's not a practice that... I hear that a lot from the industry on reasons why names act the way they do on a day-to-day basis. That's not a practice that is ever followed at Invesco funds.
But you do have to window dress at the end of the quarter or the end of the month.
We do reverse window dressing, which is particularly in stocks that we like that people haven't owned that have done real well and they scrambled on them in the last couple of days. We're selling like crazy to them because they're going to go right back down the first couple of days of the new quarter. So I actually spend a lot of trading energy in the last couple of days doing reverse window dressing. Take advantage of somebody's got to own 200,000 shares of X because it's done real well. They can have a lot of ours that day.
Okay. Ron, what do you think? Do you hurt yourself when you sell a stock at the final couple of days of the month so that your fund is showing a great return? Do you want to get back in 3 days later?
Well, I'm not sure that's what the question really is, but I mean, we don't window dress because it just costs money to do that. But where you do get hurt is if you really own a great company, you should hold on to it because that's how you really make money. Every time you sell a good one and you think it's expensive or you think the market's going to turn down and you make a sale and you look back in hindsight, it's going to be higher than where you sold it. So that's the biggest mistake we make as growth managers, I think.
Now, you're also very big into retail stocks, which have certainly performed very well as the economy has strengthened. Your two of your top 3 holdings, Tyco and Kohl's department stores. You want to tell us about those two?
Well, Tyco's not a retailer. It's more an industrial company. But we were very heavy in retailing. We've cut them back, just like we cut back technology, because the prices got too high. The consumer is in such great shape in the United States. And the first quarter was a bonanza for retailers because tax returns were 14% higher than a year ago, and they came to the public earlier. Warm weather, people got jobs, and they went out and spent money. So apparel sales went up and prices went up, and so most good consumers really blew the lights out in the first quarter. We had to take some profits on that move, and with interest rates now maybe creeping up and the Federal Reserve getting a little bit worried about too strong an economy, time to take some profits in that area. But we kept the best companies. And Kohl's department stores, you probably never heard of out here in L.A., but it started up in Menominee Falls, Wisconsin, spread through the Midwest, went through the East Coast, and it will start coming this way. A young company that just sells apparel somewhere between a department store and a discounter. It can grow its store base 20% a year, and we think earnings are going to grow 25% a year for the next 10 years. That's a growth company.
Let's go back to the studio audience. Sir, do you have a question?
Yes, this is for the panel. Is company research and development a critical factor in your evaluation of a growth stock? And if it is, what stocks do you consider the leaders in their group?
Let me
Sure.
Let me address that right away because I've been mentioning Cisco Systems. They were producing sales and revenue growth in the 40% plus area. The last quarter they did 44%. Earnings only coming in 30 to 35. They are plowing back 15% of their revenues back into R&D, research and development, and that's why they're going to be the leader in their technological fields in future years. So every good company in technology has to do that.
So you stick with it.
You have to.
John, what do you think?
Within healthcare, the resources that you devote to R&D, that is the key factor which is going to drive long-term performance. As you mentioned, between patents and just market life cycles on products, if you are not devoting tremendous resources, and in the pharmaceutical industry it's up to 20% of their revenues, some of the device companies are 15% of revenues into R&D, then in a few years you will have shown higher earnings, but I think you'll have a real revenue problem. Companies that we have in this area are Pfizer. They spend about $2.8 billion a year on research and development, and in the medical device areas would be names like Guidant and Medtronic, which are collectively spending $800 to $1 billion on research and development as well.
Okay, quickly to a break, and then we're back. When we come back in 2 minutes, we'll ask our each growth fund manager what their top pick is for the new decade. Please stay tuned for more of our coverage of the Los Angeles Times Investment Strategies Conference on CNBC. Stay with us. Welcome back. We still have so many people in the studio audience live with questions for our growth fund managers. We want to get right to them. On the right, I believe you have a question?
Yes, my question is for John. What do you think of Abbott Labs, and would you buy, sell, or hold, and do you own it in your portfolio?
For Abbott Labs, we do hold the stock in the portfolio today. It is not one of the larger positions, but we do have a position there. I would hold the stock. A few of the challenges that they will face over the next few years will be the management of a key antibiotic that they have, which is receiving a lot of competition. Despite that, they are still able to show about 12 to 13% earnings growth on about an 8 to 10% revenue growth base over the next 5 years. And so that is a name that I would recommend that you continue to hold.
Okay. Next question, also on the right.
Well, the panelists, if the perception were that interest rates were headed up, how would you each adjust your portfolios?
Okay. Ron, why don't we begin with you? Would you be adjusting if rates moved higher?
We've started to adjust already. By that we mean we are bringing into the portfolio more cyclical growth type stocks that get affected more by the stronger economy, benefit from stronger economy. If rates would go up much more, we would have to bring down the high PE ratio stocks as a percentage. We would get into more moderate growth type companies and just wait it out. But past bear markets in the United States, if you look at them, and let's say 94 and 98 were the last ones, it lasts about 6 months or less, and you better be ready to turn right around and get back in. So trying to time it, especially for the individuals, is almost a fool's game. It's
Very quickly, what are some cyclical growth names? A couple of stocks.
Tyco is one that we mentioned, industrial type company. Another field that we moved into were the energy stocks in the oil service and oil drilling companies. As the price of oil now goes up, it goes above $15 a barrel, which it is now, 17 to 18, they can start drilling again, especially shallow drilling in the Gulf of Mexico. It's starting up again.
John, would you be adjusting?
2 points there. One is when rates do tend to move up in a rapid fashion, the market generally will adjust your portfolio for you. So
you can say that again.
However, during that process, we do look to trim some of the higher multiple names in the portfolio. However, our discipline still is to look for these companies that are good growth companies, not driven by pricing or dependent on higher multiples, but rather unit volume growth, which is driving earnings. So we'll try and ride it out.
Garrett, are there any stocks that actually benefit from higher interest rates?
Well, the last time we had a true rise in interest rates over a long period of time in the 70s, there were a lot of stocks that benefited. Again, we had higher inflation levels then and moving up. The resource stocks did very well at that period of time. Also, believe it or not, small cap growth stocks did very well. There was a theory at the time that they were the true unit growers, and if you were going to beat inflation, you needed to participate in that sector. So
how will you adjust?
Well, we'll raise some cash. We wouldn't eliminate positions, but we'll try to get our head down a little bit. But I'm of a mixed emotion because the last time around, I was in the business back then, the small cap stocks did really well in higher rates and higher inflation. So I'm sort of there with my fingers crossed that we'll have a repeat of that cycle.
Okay. Our next question to the left. Yes, sir.
In 1997, the physician management companies climbed up the ladder like lightning, and then in 1998, the ladder was cut out from under them. Where do you think, John, the physician management companies are going? Is there such a thing now as a physician management growth company?
During that period, when the physician practice management companies, what these basically are is they're holding companies to help physicians manage their business more efficiently. We had owned a lot of these companies, Ficor and so forth, but we sold many of these companies going into that cycle, and the reason is that with roll-up type companies where a big driver to your revenue growth and earnings is acquisition, those type of strategies are generally business strategies that work right up until the day that they stop working. And you never really know when that day is coming. So we were very cautious on the names, and we had sold them out. The future for them, the business models, they're under tremendous reimbursement pressure from managed care as well as the government, and so we are still not yet looking to invest in these companies.
Okay. Our next question on the right. Yes, sir.
Thank you. My question's for Garrett. And do you think that the money that used to be invested in or in small cap stocks has really drifted into the internet field, and that's why small caps have underperformed?
Well, I think that may be part of it. Certainly, I think individuals have gotten more confidence to invest themselves, particularly in more esoteric industries. The internet would be one. So that may be the case, that we've seen people who would have bought funds like ours and directly invested in the internet. I think we'll see that money come back over time. The last couple of weeks with the internet stock prices, that may be starting already.
Very quickly, what is your question?
It's about CMGI, buy, sell, hold.
CMGI, Garrett?
Sell it. It's a great company. They're a holding company that's got a lot of internet investments. They're extremely well run. They've got a number of fabulous properties that'll come public over the next couple of years, and I think the stock's going to go down.
Well, that doesn't make a lot of sense. So why don't you explain that for us?
Shorter term, I think that, we're around Memorial Day, and between Memorial Day and Labor Day, the technology stocks generally do very poorly. I expect them to do poorly this year, too, and CMGI, which is a leader in the internet and technology, probably won't have a very good time about it relative to its stock price, but the company's executing beautifully.
John, quickly on CMGI.
That's an area that we have looked at, not necessarily from technology, but trying to find more merchandise for new healthcare names. So I'm not comfortable commenting on CMGI, but...
ISC. Okay, Ron, do you like it
That's
or
a
not?
name we own a small position in. We've cut it back, mainly because of Garrett's comments that the prices got too high, and we're looking to come back in, but maybe 20–30% lower.
We have to wrap it up. I do want to get the growth stock for the next decade from each of you. Garrett, I begin with you.
Thanks, Maria. Boy, 10 years is a long time. I think that what I'd do is stick to that communications theme and give a name like North Point Communications, which is in the really providing the service of high-speed access. I think that as individuals get hooked on more bandwidth and learn the applications they can get from higher speed internet connections, that's really going to be a driver.
John, one stock to hold for 10 years.
Guidant. They're a medical device company. They're leaders in vascular, which is stents and catheters, and they're also one of the leaders in cardiac rhythm management, which is pacemakers, defibrillators, and the emerging technologies for congestive heart failure.
Okay, Ron, you're up.
I'm going to stick with Cisco Systems. It's been one of the best for the last nine years. It's hard to bet against them. I've got most of my personal money there, too.
Thank you very much. We thank our guests for being here. We thank our studio audience. We'll see you. Thanks very much for joining us.
Thank you.
Welcome to this hour of our special program, the Investment Summit, the third annual Los Angeles Times Investment Strategies Conference. I'm Tom Costello, and we are in sunny Los Angeles at the huge Los Angeles Convention Center. During this hour, we're going to take a side trip. While most of the focus is on popular investing right now, internet stocks, blue chips, growth stocks, we're going down the road less traveled on this hour. We're going to look at investments that are off the beaten track. And what does that include? Just about anything that is not internet, blue chips, or large growth stocks. We have a lot to talk about, and here to lead the way three money managers who might be called a bit offbeat themselves. The first, on my left, is Richard Kane, Rick Kane. He's the co-founder and chief executive officer of Kane Anderson Investment Management here in Los Angeles. Rick manages about $5 billion for private clients and institutional clients. His Kane Anderson small cap composite has a 5-year average annual return of 19%. But we should point out that Rick manages many different funds, and that's just one of them. Next to him, we have Stephen Romick. He is the senior vice president of First Pacific Advisors, and also in Los Angeles, a chief investment officer of the flagship FPA Crescent Fund, has a 5-year annual return of 15.5%. And on the end, aren't you glad I fixed that?
Thank you.
On the end is the well-known value investor Martin Whitman. He is the chairman and chief investment officer of Third Avenue Funds in New York. He has been called a vulture investor. We'll have to ask him about that and see what he says. His Third Avenue Value Fund has a 5-year average annual return of just under 16%. Gentlemen, welcome. Nice to see you here in L.A. And let's begin this discussion by finding out exactly what is a non-traditional investment. And Rick, you call yourself non-traditional, but not necessarily contrarian. So what do you mean by that?
Well, let me take 1 second and first of all qualify something. In your introduction, you were nice to say that I manage $5 billion. I would like to qualify that. My co-founder and I, one of our initial objectives in starting our firm was to hire people smarter than we were, and we were commenting just the other day and lamenting at how successful we'd been. So
I'm sorry.
But our firm manages both investments on and off the beaten track. With regard to non-traditional investments, which actually were the roots of the firm many years ago, we define those as investing in neglected, overlooked, and misunderstood opportunities, which essentially is define what traditional investors are looking at, and it's everything else. We have a certain subset of that we're particularly interested in, but that would be the definition of it. There would be another part of non-traditional investing from our vantage point, and that would be a difference in mindset between what we call absolute investing and relative investing.
Okay, tell me your top 3 holdings real quickly.
Top 3 holdings would be a company called Foremost Corporation of America, one called Plains Resources, and aligned with that is something called Plains All-American, and the third would be the Right Start.
And we need to point out that your company owns pieces of all these companies, correct?
Our company is our major stockholders of all 3 of these, and members of our investment team are on the boards of directors of these 3 companies.
Okay. We're going to come back and talk to you. Stephen, you and Martin are what you call value investors. So why is value off the beaten track? What do you, and if so, why do you consider yourself a contrarian?
Well, first, small cap value, as a small cap value investor and someone who also seeks value in other parts of a company's capital structure, busted preferred stocks or convertible bonds or the straight debt of a corporation, has been lately not so much investing off the beaten path as so much as it has been on the path to getting beat up. And in that process, we are looking for companies that are good businesses that, as Rick was pointing out, we consider have a very strong definition of what the absolute value of this enterprise is. Just because some company is trading at 100 times revenues, and we find another internet stock, for example, trading at 50 times revenues, doesn't mean that it's cheap. We'd rather find a business that has great fundamentals, that's going to be around for a long time, and we have a lot of free cash flow that the business is throwing off.
Top 3 holdings are?
Midas Corporation, the muffler people, which is a smaller, increasingly decreasing portion of their business. Michael's Stores, the arts and crafts retailer. And our third position actually is one that overlaps with Rick's, which is Foremost Insurance. Which probably means that people shouldn't be buying that, if 2 panelists own it.
And you like busted convertible bonds. We're going to get to that in a minute and explain what that means. And on the end, there in the anchor position, we have Marty Whitman from Third Avenue Funds. Marty, I read your book. Marty has a new book out called Value Investing, A Balanced Approach. Martin says in his book, value investing entails what is safe and cheap. Now, the operative words are what and safe and cheap. So tell me about this.
What is safe and cheap?
Right.
What is refers to the values that exist in the business at the present time rather than reliance on predictions on the future. It means there's an emphasis on being price conscious rather than outlook conscious, Most people on Wall Street are price unconscious. They just,
In
they just
1999, that
concentrate
certainly is the case.
on the outlook. Safe refers to the business, not the price of the stock. It refers to a business either being so strongly capitalized or having such a strong franchise that it's unlikely to get in trouble. And by the way, well-capitalized has three characteristics, the most important of which is an absence of liabilities rather than the presence of anything else.
Can I quote from your book again? In
Well,
your book?
I didn't do cheap yet.
Do cheap, do cheap.
Cheap is paying no more, in a non-arbitrage situation, paying no more than 50 cents for each dollar you think the common stock would be worth, whether the business a private business or a takeover candidate.
Doesn't sound like Yahoo, AOL fit into your plan there.
Only if we could get in on a promotional stage as a venture capitalist. Never, we wouldn't pay 500 times what a venture capitalist would pay for anything. We're not that good at predicting the future.
You also say asset allocations are driven by price as related to the three factors inherent in a company. This is the basic stuff in picking stocks, right? Quantity of resources, quality of resources, and long-term wealth creation potential.
Yeah.
That just sounds like common sense, but maybe we moved away from common sense in stock picking.
No, one of the things is, yeah, everybody is concentrated on earnings. What's that got to do with the quality of resources or the quantity of resources? Reported earnings. It's a more balanced approach. You don't ignore earnings, but it's part of the whole business cycle or the accounting mix.
Okay.
And long-term wealth creation says that businesses are in the business of trying to create wealth, and there's any number of ways in which they could create wealth. Those are having improved operating earnings, mergers and acquisitions, refinancing, spin-offs. And most smart businessmen away from Wall Street would much rather create wealth by some method other than having operating earnings.
Let's pick up on that when we return.
Operating earnings are taxable.
We have to take a break, and when we return, we're going to start looking at some of the places our money managers here say you should visit for some good investment ideas. Stay tuned for much more of our special coverage of the Los Angeles Times investment strategies right here on CNBC. Welcome back to our special program, the Investment Summit. I'm Tom Costello, and during this hour, we're tracking down stocks and other investments that are considered to be off the beaten track a bit. Joining me here on stage to do just that, we have Rick Kane of Kane Anderson Investment Management, Stephen Rolnick of First Pacific Advisors, and someone who's been called the Dean of Value Investing. We have Martin Whitman of Third Avenue Funds. Rick, let's begin with you again, and if you look forward for the next 1 to 3 years, what do you like that is off the beaten track? Where would you be putting your money?
Well, you asked earlier for the names of some of our larger holdings, and Plains Resources was one of those, and that would be a key place that I would be. Plains is a small public oil and gas company, which in the world of investing that we've traveled through in the last 2 years is sort of a convergence of all things unpopular.
Yeah, oil and gas have not been popular, especially the last year or so.
Small has been at the back end of the caboose relative to large, and oil and gas has been, a very difficult area in the markets.
You're betting it's going to come back in the next 1 to 3 years?
Well, I think that there are a lot of dimensions to the oil and gas market that are very, very favorable. I think there's been an inducement of disinvestment by virtue of the low oil price, and now we're starting to see it come back a bit. But this particular company has certain unique aspects of it. It's got oil and gas activities. As a matter of fact, for those of you who are in Los Angeles and you drive down La Cienega Boulevard, you see their wells pumping up and down in the Stocker fields. But they also
Just so our audience knows, what are the symbols you're talking about here? What are the ticker symbols?
The common stock of Plains is PLX. They also are a 57% owner of a master limited partnership that trades on the New York Stock Exchange by the name Plains All American, and that is PAA. And PAA is one of the largest factors in the movement and marketing and transportation and trading and storage of crude oil in the United States.
Okay.
It's the holding of Plains All American, Plains Resources holdings in Plains All American almost equal the value of Plains stock.
Okay, and Glacier Water you like as well, right? And you have, we should say you have a position in that company as well.
Glacier Water is another that we're a very large holder of, and I'm on that board, and as well as other members of our team. Glacier is the largest, actually the largest factor in the water business in the country. It's a very small company, but we have a unique way of addressing the delivery of high-quality, purified drinking water to individuals. If you've noticed, and you go into the supermarket, you see very, very large sections of water sections, and which have expanded with the demand for purified, high-quality, good-tasting drinking water in the last few years. We do things differently. Instead of supplying gallon bottles for the shelf, we actually bring our factories to retail locations. We have about 13,000 machines, typically in front of supermarkets around the country.
By the way, the symbol there is H2O, or HOO on the Amex, right? Marty, you look bored. Do you disagree with all of his choices?
I don't know anything about them. It's very, very educational lesson.
Steve, what do you like over the next 1 to 3 years? In my notes here, I've got busted convertible bonds. Perhaps our audience needs a primer on what that means.
Well, first, I think I should start off by saying that one of the goals of the UAM FPA Crescent Fund is to generate equity-like rates of return with less risk on the market as a whole. And to do that, we not only buy common stocks that might be off the beaten path, but we're also seeking value in other parts of a company's capital structure. It could be, the convertible bonds. And so a convertible bond is a bond that's issued by a corporation with a lower yield than it would issue a straight bond at. They're borrowing money from the public. And when we get in, it's not usually at the offering price. It's usually after it's declined, because these convertible bonds have the option to convert into equity if the stock does extraordinarily well. Well, usually we get in after the stock has not performed extraordinarily well. And so we are able to pick up these bonds with relatively high yields and have some, although very out-of-the-money, equity option. And so one example of that might be, which lowers the risk in the portfolio, would be a position that we have in a local real estate manager, property developer, landowner called Center Trust Properties, which is partially controlled by a New York firm called Lazard Frères. Now, this convertible bond is trading down at 93.5 and yields a 12.5% to maturity. Now, 12%, 12.5% to maturity, and maturity is only a year and a half away. Now, historically, that has been above average equity rates of return. If you look back over the recent few years, it pales in comparison to what the S&P 500 might bring. But this is a very low-risk investment as far as these kinds of investments go, trading at probably what we would estimate to be a 70% loan-to-value.
But I think that's the point. When you got AOL with staggering returns, and same with most of these internet stocks, and many high-tech stocks, and for that matter, some big chip companies. GE's done very well over the last year or so, GE, the parent company of this network. Is it hard to get people interested in bonds when you've got 70% returns in some of these high-flying stocks?
Sure, it's difficult. I mean, in fact, today, you can be downright frustrated.
Yeah.
And if you look at, through the end of April, roughly, if you looked at the Russell 2000, one of the benchmarks that I'm compared to, of the Russell 2000 through that point in time, the index was down about 1%, or was up 1%, sorry, after that point in time. And if you look at it, if you owned all of the companies that didn't earn any money, they're estimated to earn no money, lose money this year, you would have had a 24% rate of return. If you owned companies that were going to make money, you were losing 1%. So you're much better off, over the last year and a half or so, to own companies, frankly, that don't make money. We're interested in companies that make money both today and in the future. So we spend time looking at those kinds of businesses and stay away from those that are very widely accepted. We don't think that there's a lot of money to be made by following the herd.
Okay.
I mean, your parent company, GE, it's nice that you're a parent, so I don't want to say anything too negative, but at the same time, last time I checked, it's a cyclical company. I mean, from jet aircraft engines to financial services.
Okay, we got to go to another break. And when we come back, we're going to ask Marty about his vulture reputation. We're also going to talk about investing without looking at technology, and we'll look for some off-the-beaten-track investments, maybe even high-tech investments, right after this. So stay with us. Welcome back to the Investment Summit. I'm Tom Costello, and joined by three so-called offbeat money managers. We have Rick Kane, Stephen Romick, and Martin Whitman. Martin, let's begin with you. Talking about techs, is there anything that you do like in the tech sector you might be interested in? What about chips?
Oh boy, we have 25% of our assets in extremely well-capitalized semiconductor equipment common stocks.
Can you give us some names?
I will give you the names we're buying right now are FSI International, Electroglass, Speed Fam, AVX, Silicon Valley Group, CP Claire.
Why do you like these? Go ahead. I was going to ask you, why do you like these? Because chips have been hit the last couple of days.
Well, let me put it this way. If the internet, which everybody is very interested in, is going to realize its potential, I dare say it will only do so against the background that there will be an explosion in demand for increasingly sophisticated semiconductor chips. We are buying into these very, very well-capitalized companies.
Why not Intel?
At prices, huh?
Why not Intel?
Let me finish, please,
Okay,
Tom.
all right.
And then I'll tell you why not Intel. We are buying, the reason why I'm not buying into Intel, which I might, is we are creating these positions at maybe less than half the price we would have to pay when we're financing these companies as a first-stage venture capitalist hoping to take them public. In average internet stock, I would dare say today that's already public, you're paying 200 to 500 times what you would pay if you were a first-stage venture capitalist financing these companies. I'll take my shot paying 50 cents, even though I'm just buying an internet participant rather than a pure play. I think Intel is a wonderful company. It's just a matter of price. It's a matter of being price conscious. I'm not getting in at 50 cents on the dollar. There are it's an industry with very, very many fine companies. We're price conscious.
Rick, what about you? Anything in the tech sector you like, or chips in particular?
No, that's really an area that's outside of what we deem to be our core competency. We do, from time to time, get involved in identifying securities, and as Steve talked about, broken converts and different kinds of securities that by their nature provide some downside protection and give you an upside kicker on technology, but we don't feel competent really to make an assessment in that area. It's just outside of
What would you stay away from at this point?
Well, we stay away from everything that we don't understand, and that's a lot.
Okay. Stephen, any advice to that effect? What would you stay away from at this point?
There's a lot of companies that, I mean, I wouldn't go so far as to say I would short these companies, but the internet stocks trade at peaks beyond what RCA reached in 1929, Xerox reached in 1961, and Apple reached in 1980. I mean, many, many, many multiples of what those companies had, and each of those companies actually had earnings. So I would stay away from them because I think the key variable that's being missed today is everybody's so focused on the return, they're forgetting the downside. Stocks do go down, and you know, the bigger they are, the harder they can fall. So it's something I would avoid. I also would avoid, I mean, people should buy what they know, and we do a tremendous amount of work, not just looking at the companies themselves, but talking to vendors, suppliers, customers, and people that used to work for the company, tracking these kinds of people in a grassroots fashion. And in trying to accomplish that, we want to buy what we know. And I think people should do that, because if you look at a lot of these companies and looking at the income statements, some of these companies that are very well known, like Warnaco, which owns Speedo and other apparel products. This company has generated no retained earnings over the last 10 years. None. In fact, they had $60 million in negative retained earnings, in 10 years ago, and today they've got 190 million in negative retained earnings. So there's a lot of other accounting issues that can go on with a lot of these companies. I would stay away from what you don't know.
Would you agree, though, with this idea that we have entered a whole new paradigm, and it's difficult to evaluate how productive this sector is going to be because the sector is so new, talking about internet stocks in general, and that while most people agree that these stocks are overvalued, it's difficult to get an accurate price on what they should be?
That's fair. I mean, I'm willing to sit here and say that I don't know what the value of AOL should be. I'm just, as the kind of investor that I am, I want to have a sense of what the value is and what it should be. So I'll leave it for somebody else to try and guess what the value is going to be. But I know that I took AOL 10 years and grew their revenues at 30% a year for the next 10 years and took their operating margins, made them 2.5 times what they were last year. That company would be trading at 29 times what they're going to earn in the year 2009. So I'll just leave that to somebody else.
Marty, you're shaking your head.
I think in terms of the internet, in terms of the Standard & Poor 500, it's very, very hard to make the numbers work. For internet stocks, possibly today's prices will be justified, but it will only be justified on the basis that they would continue to have access to capital markets to sell new equity at these unbelievable prices. If you believe that's going to persist, be the first time in history it would persist, but if you want to believe it, go ahead. We
Rick,
deal in probability.
do you believe that we have entered a new paradigm with regard to evaluating and valuing these companies?
No, I don't. But I would say, while I talked about not having a core competency in the technology area, one of the companies that I mentioned that's a large holding of ours is a small company. If there are any of the viewers that are young mothers or recently young mothers or parents, they might recognize the Right Start, which is been a catalog retailer and is now going onto the internet.
I got to stop you. The computer's going to shut us down. Speaking of high tech, we'll be back in just a minute. Stay with us. You're watching CNBC. And welcome back to our special program, the Investment Summit, the third annual Los Angeles Times Investment Strategies Conference. I'm Tom Costello. We here at CNBC are participating in really a fabulous investment conference at the Los Angeles Convention Center, and we have a very large studio audience for this program. We want to get right to their questions, and here to answer them are three money managers who don't follow the crowd when looking for investments: Rick Kane, Stephen Romick, and Marty Whitman. And we begin with a question from my right in the audience. Go ahead.
There are lots of mutual funds that invest in dividend-paying companies. Are there any specific funds that you're aware of that invest in consistently increasing dividend-growing companies only?
Rick, you want to take that?
That's right on point. Kane Anderson follows a discipline called the rising dividends philosophy, and it's in large cap, small cap, and in international. I don't know all the other mutual fund groups that do that. There are a couple that have it in its name, but that happens to be the investment philosophy of our traditional side.
Okay, we have an audience question over here.
Yeah, Stephen, you mentioned about convertibles. Do you have a good resource of that information, publication and stuff?
The research that we use is really, in fact, when I find convertibles, it's usually as a byproduct of my equity research. I spend a lot of time on a company or another company in the same industry, and I see that this might be an attractive way to invest in it. For example, Marty was talking about semiconductor capital equipment manufacturers. I don't feel I have the same wherewithal and capacity to understand some of these businesses, and yet I did make an investment in Lam Research convertible bonds in the depth of the Malays last fall. So I really get through through the back door, if you will. Now, for individuals, I mean, if they deal with certain brokerage firms, they have convertible publications. And if you ask your brokerage firm to supply you with that, they have lists of convertibles, and you can see names of companies that you might recognize. The important thing to consider is the way we invest is you want to buy those converts with higher yields rather than lower yields.
I think we have a question for Marty over here about real estate. Go ahead, sir.
Actually, it's here.
It's over here, I'm sorry, okay.
Marty, I understand that you have unusual ways of investing in real estate, and I'd love to hear about that.
Well, we're very heavy real estate investors. It's one of our off-the-beaten-path investments. As you, let me give you a given. Real estate securities, 90% of the time, are a lot cheaper than real estate. And they're very easy to analyze by our criteria of cheap, of buying them at a big discount from appraised values. As many of you know, we bought out the Los Angeles Times Mirror's 31% interest in Tejon Ranch, and we're now the largest stockholder at Tejon Ranch. Another California real estate entity that's selling at a huge discount and very well managed is Catellis Development, if I've pronounced it right. We also are heavy in income-producing real estate. Our largest real estate holding is Forest City Enterprises of Cleveland, an investment builder, the largest company in the world that nobody ever heard of. A huge, important national developer. We also are heavily invested in Koger Equity, most of which securities we got at in a bankruptcy reorganization, which has suburban office parks throughout the southeast and much of the southwest. In each of these cases that I've mentioned, I think present prices are no more than 50% of appraised value, insofar as you can figure out an appraised value.
So how do we, the public, benefit by do that? Like,
Well, if you want to know about Forest City, read the annual report.
is it publicly traded?
Yeah, on New York Stock Exchange. I mean, you have a management going on about length, about how they don't understand how cheap their stock is. They used to publish Landauer appraisals and gave that up.
What's the symbol there, Marty? Do you know it offhand?
FCEA.
Okay.
I don't know. I think Catellis may publish something.
Okay.
Koger Equity, just look at the multiple of funds from operations, FFO. And you could say in the market for office buildings, they might be entitled to an 8% cap rate, and you'd see the thing is selling at maybe 5 times.
Okay, let's move on to another question over here on the right. Go ahead, sir.
Yes, I'm looking for relatively unknown broadband companies to invest in for the medium and long term. Do any of the panelists know about a DSL company called Mphase? The symbol is XDSL.
I don't.
No?
Not
Stephen?
me.
No? How about another high-tech question, since they don't? Any other question for them?
That's my question.
Okay, all right. What about, you were picking up on this theme, if we could, Stephen, and also Marty, about chips, and chips went through a bad period 6-9 months ago. Are we out of the woods on chips in terms of the problems they've been having with the whole sector? Stephen?
Well, I think that the worst is behind us. I mean, as Marty's pointing out, these companies are some of them extremely well capitalized. When we were buying Lamb Research notes, the company had more, cash equal to debt. I mean, her net cash position in the portfolio. It's a very cash-rich company. That was very out of favor. But going forward, I mean, what we hear, one of the issues has been the amount of capacity that had come on stream. At the same time, demand was falling off, especially in the Pacific Rim. Well, we're beginning to see some strength in the Pacific Rim now. I don't know that if it's a dead cat bounce and it's going to go down again, or if it's going to continue trending upwards. But from the research that we do, and one of our larger investments is a company called Fritz, which is a freight forwarding company, that we can talk to them and they can tell us what's coming out of the Pacific Rim and give us a perspective. And what's more importantly, what is being imported now in the Pacific Rim from the U.S. And that tells us a bit about the strength there. So I think that's going to help the semiconductors companies.
Okay. Let's take another question. Go ahead.
Let me suggest to you, Tom, that that's an irrelevant question from any value or long-term point of view.
Well, you're right.
The thing that counts
That's right.
is if I'm going to equate it to some industry that's going to participate in the Internet, its problems and potential are nothing to do with the next 6 months.
Yeah, you're right. It runs contrary to your view that you should be in it for the long haul and not the next 6 months.
Yeah, okay.
We're going to take a break, and Marty will probably beat me up a little bit more and stay with us You're watching the Los Angeles Times Investment Strategies Conference right here on CNBC. Welcome back. We've been sitting around having a nice leisurely conversation while you've been gone, and you're at the Los Angeles Times Investment Strategies Conference. We're talking about investing off the beaten track with money managers Rick Kane, Stephen Romick, and Marty Whitman. And we have a question from the audience. Sir, go right ahead.
Yes, this is a question for Marty. Marty, what are your thoughts on Japan these days, particularly the financial services industry in Japan?
Japan sucks. Our investments in Japan are restricted to two things that are priced tremendously attractively. One, we're in the non-life insurance companies, each of which are big blue chips, and these are the only financially, only strongly capitalized, surplus capital companies in an economy that's woefully capital short. And we've bought them at anywhere from a 30% to 80% discount from NAV if they accounted as if they were investment companies. The other area we're invested is in affiliates of Toyota Motors, where you have opportunities to set up positions in Toyota Motors common stock at very, very substantial discounts, 30% or more.
What about the rest of the Asian Pacific Rim? Is there anything are those economies starting to recover substantially enough that we should be considering looking for stocks off the beaten track? Stephen, what do you think?
I don't do a lot overseas, so I'm not terribly helpful on that front, but I did try and look for companies that would benefit from an improvement in business in the Pacific Rim, and one of those companies is the Fritz Companies, which is a global freight forwarder, one of the largest companies in the industry. And a freight forwarding company effectively is a travel agent to large shippers. So if Gap stores manufactures or sources sweaters from Singapore, this is the company that will get it from the manufacturing facility to the docks across the ocean, through customs, into a staging warehouse where it's broken down and either drop shipped to the stores or end up in the distribution center. And this stock is a company that's come down from $40, ended up down as low as about 6 3/4, has now moved up a little bit to 11, but you know, our cost is down around $8, so it has moved up somewhat. But when we look at this business, there's tremendous growth potential worldwide for this company. Now, the company got in a lot of trouble with mistakes that management had made and a number of bad acquisitions, one large one in particular. But as a result of bringing in a new management team, a new CEO who has a tremendous reputation, and I've actually interviewed people that used to work for him in his prior company, the company's operating margins and revenue growth should be substantial going into the future. So we have high prospects for that.
Marty, you really stay away from Malaysia, don't you?
Yeah, no, we, as a matter of fact, we're the leaders of a group that is attempting to buy Hanbo Steel out of the equivalent of Chapter 7 in South Korea. There's a very, very large mini mill, and I would suppose we have a good chance of creating our position. But I did want to comment that there is no way we would ever make securities investments in emerging markets, in Asia outside of Japan. Direct investments where we have some control is fine. But in securities investments where you're an outside passive investor, to go into those countries where you have no disclosure, you have no securities regulation, it's an invitation to get raped.
Okay, let's take another question over here. Marty's language is colorful and insightful. Go ahead, sir.
I'm looking at Carl Jr.'s as a value play, and I wanted to get the panelists' opinion on the Carl Jr.'s, the restaurant chain.
Rick, Stephen, you know Carl?
I've actually spent a lot of time with that company. We are not shareholders in the company today, but I can tell you it's something we have spent a lot of time on. It has tremendous prospects. Carl's Jr. has the restaurant chains here, fast food, but they also had acquired in the last year and a half all the Hardee's franchises. They're controlling a lot of company-owned stores as well as the franchisor of the Hardee's name. And it's been a rough go so far. The company has tremendous management right now. And I don't know if the stock appears to be cheap as it's trading at 10 times this year's estimate. I don't know how much conviction I have in the number today. It depends. They can make their earnings if the company is successful with Hardee's, with their new game plan that they have, but I don't have a good idea of where that stands. But you can also buy a busted convertible bond in that company as well and get a yield of 11% at today's prices.
Okay, Rick hasn't, go ahead, Rick.
I will add one of our associates. In the non-traditional areas of our business, a number of our people, as opposed to just being investment professionals, have had operating experience and financing experience, et cetera, in the various businesses. One of those happens to be a guy that came out of the restaurant business and thinks particularly highly of Carl's at this point.
Okay. Question from the right. Go ahead, sir.
What is the basic steps to evaluate internet stocks?
Basic steps to evaluate the internet stocks. Who wants to take a crack at that?
As Warren Buffett said at his annual meeting, he said, and I wasn't there, but this was passed on to me from somebody who was, somebody asked that question, and he said, if I was teaching a business school course today, I would give the class an internet company to value, and if they turned it an answer, I'd fail them. I think that best sums up my opinion. I would echo his sentiment.
How you decided whether the stock is cheap or expensive?
Well, that kind of picks up on what we were talking about before. How do you know if the stock is cheap or expensive? And it's hard to evaluate that, isn't it?
No, sometimes it's very easy and sometimes it's very hard. I was asked a question about real estate where sometimes it's very easy. The financial institutions where we're very concentrated, I think valuations are very easy. Internet, for us, they're impossible. I wouldn't know what criteria to use except to say I have to make some assumption about their continued access to equity markets on a super attractive basis. Most things are very, very hard for us to value. We just don't do them.
Okay. One more break, and then we'll be back. So stay with us. We have a lot more questions from the audience. You're watching CNBC. Stay with us. And welcome back to the Investment Summit. We are wrapping up this hour with our three offbeat guests. We say that affectionately: Rick Kane, Stephen Romick, and Martin Whitman. And we have several more audience questions. So we're going to begin over here on the right. Go ahead, sir.
Yes, I was wondering if any of you invested into companies that are environmentally conscious. That might be, trying to save the economy or globally, working on things to try to work it out for our environment.
Rick?
We always concern ourselves with the environmental responsibility of the companies we're involved with, but as I mentioned earlier, one of my favorite stocks is, and our areas of focus of ours is in the petroleum business. The people that we involve ourselves, actually Plains is won honors year after year for the environmental friendliness of this and responsibility of this organization. I think we care about their responsibility. We don't confine our investments to those things that would be necessarily considered to be green.
Okay. Go ahead, sir. Who had a follow-up comment?
Yeah, with our emphasis on strong financial positions, we don't go into companies where the footnotes disclose tremendous environmental liabilities, and I would think every company in the United States that has potential environmental liabilities now discloses them in great depth. We sort of back into being environmentally friendly, I think.
Okay. Over here, sir. Go ahead.
Speaking of off the beaten track, the bicycle maker Cannondale recently came out with a motorcycle. Apparently great reviews, sold out, but the stock hasn't moved. Do you have an opinion, either of you?
We happen to be the largest stockholder, outside stockholder of Cannondale. And it's a...
So you like this stock, don't you?
Well, the company is a very innovative company.
Mm-hmm.
I don't know whether this gentleman has been involved with their bicycle products, but Cannondale is over here and everybody else is over there in terms of the nature of the way they have conducted their business. They've designed it themselves. They actually are a company that where their employees are their customers in a sense that they have deep passion for their products. And those people brought passion and innovation to the bicycle business, and now they're in the process of doing that to the motorcycle business. My view is we still don't know whether the motorcycle works. It is it is a leapfrog with regard to innovation, frame technology, new engine design, and on paper it's terrific. I think people will get them in their hands relatively soon, and if they work, I'd look for wonderful things from that company.
What's the stock price at right now?
Stock's in around 9.
Okay.
I should have planted the questions too.
Yeah. Go ahead, sir.
I'm a big fan of Laszlo Barini's money flow thinking. Follow the money. Where's the money going? Would all three of you or one or two of you like to comment on sectors? Are we seeing a lot of flow into the mid-cap and small-cap area yet, or is that what the press is talking about, or where is money flowing today as far as new investment money?
Stephen, want to take that up?
Yeah, money flow has been out of my sector. I mean, I feel like an ATM at a mall where this money just keeps going out. But at the same time, it doesn't take much in small cap to cause it to come back up. And when I say much, in terms of a lot of capital coming in, we've had in small cap, all the money that came in the year and a half preceding 1998 has gone out and more, looking at the data. And there's been some trickle back in. And all that trickle, I mean, that little bit of trickle is what's caused the small caps to stage a bit of a rally over the last 6 weeks. Now, if people are trying to time the market and wait until they see the money flows in hindsight to try and get in, they're going to be too late. I mean, in January of 1975, small cap stocks, coming off of a terrible few years, were up 27.5%. In the first quarter of 1990, coming off of, a weak few years, or actually first quarter of 1991, I apologize, they were up 28.7%, I think it was. So if you wait for that data, it's too late. So the best perspective, we feel is our perspective, which is to invest in these businesses when they're out of favor and have a longer-term point of view.
Let's get one more question in. Go ahead, ma'am.
All of the conferences I've been through, nobody talks about aerospace as an investment. Is there a reason, gentlemen?
Quickly. Somebody have a quick answer?
Oh, I don't have a quick answer, so I'll delay it or pass it off to Marty. He probably has a good answer.
Anybody invested in aerospace here? No. Okay. With that, let me get your thoughts as we wrap up today. What's your top stock pick for the next 1 to 5 years? Rick, let's begin with you.
Well, I've got to say, in the whole area of non-traditional investing today, from my vantage point, it's a candy store, and to pick one would be difficult. I've mentioned some of our top holdings. Okay. I'm very enthusiastic about those.
Okay, Stephen.
Well, I like what Rick said. I don't know, that gets me off the hook from mentioning one. But if I had to pick one of the names that I mentioned today, and my largest holdings partially have gotten to that position because they've already done so exceptionally well. But if I were to look out over the next 5 years, I would love to own Fritz with the management team that they have today. And recognizing that although it's $11, it could go to $8 before it goes to $40. I think there's tremendous revenue growth in this industry, and the company's margins are way below their peer group.
You've talked about this stock all day. You must really like this stock, huh?
Well, I've got a lot of stock in there. I mean, I hope somebody else buys it.
That's what I was looking for. Marty, what do you like going forward?
Since I haven't talked about financial institutions, let me throw out La Salerie on the New York Stock Exchange.
What's the symbol, do you know?
LSH,
okay.
But don't hold me to that. I don't. Well, I believe it's LSH.
Okay, gentlemen.
It's a Bermuda reinsurer.
We got to say goodbye.
Goodbye.
We've come to the end of this hour of the Investment Summit on investing off the beaten track. We'd like to thank our panelists, Rick Kane, who was here, the Chief Executive Officer of Kane Anderson, also Investment Management. And we have Steve Romack, who's here as well, Chief Investment Officer of the First Pacific Advisors Crescent Fund. And, of course, the one and only Marty Whitman, Chairman of the Third Avenue Funds. Thank you, gentlemen, for being with us. And our thanks to this very large studio crowd for being with us as well. We appreciate all your thoughts. Thanks for coming in. And during this hour, we hope that we've given you some offbeat ideas for your portfolio Don't go away. Coming up next, Sue Herrera will chip away at blue chip stocks, and I'll be back later on today to log on to the internet. We'll have some great tips for online investors. Thanks for watching. Have a great day.
Welcome back to our special holiday program, the Investment Summit, the third annual Los Angeles Times Investment Strategies Conference. I'm Sue Herrera. We're here at the huge Los Angeles Convention Center for a fascinating two-day investment summit. There are 160 money managers and analysts here, as well as about 12,000 participants, talking about everything from IPO investing to women's investment issues to financing your kids' education. And today we're bringing you just a selection of the panels. So during this hour, we are choosing the blue chips, the so-called big-name blue chip stocks. They've led the market since 1995, but they've started to stumble just a bit. So joining me to see if they will still play a role in your portfolio are four blue chip money managers with stellar blue chip records. First, Robert Bissell. He is president of Wells Capital Management here in Los Angeles, and his flagship Premier Value Fund has a 5-year average annual return of 24%. Next to Bob is Roger Engelman. He is founder and president of Roger Engelman and Associates in Pasadena. His Phoenix Engelman Nifty 50 fund has a 5-year average annual return of just under 24%. And next to him is Judy Jones. She's now a consultant with Key Asset Management in Cleveland until her retirement 2 months ago. Judy managed the Victory Value Fund, which has a 5-year average annual return of 24%. And on the end, Fritz Reynolds. He is the president and portfolio manager of the Reynolds Funds in Larkspur, California. His Reynolds Blue Chip Growth Fund has a 5-year average annual return of just under 33%. So, pretty stellar returns for all of you. Welcome. It's so good to have you all here. We're going to try and give people really a pretty broad overview to start with and then work our way down into, some specific stocks and sectors that perhaps you're watching right now. And you're the lucky guy because you're sitting right next to me, Bob. So I'll start with you. And because the market has been changing so dramatically over the last couple of years, some people feel as though the definition of blue chip has also changed. So how would you define a blue chip nowadays?
So I think blue chip is one of the most fascinating topics. If you delve back into the literature, it's very hard to find a definition of blue chip. And they're kind of like sports teams. We all know when they won what a blue chip or what a premier sports franchise was. But if you try to pick one a year out, it's a lot more difficult, a lot more challenging. I think there's 3 elements that we all look for, though, when we're looking at blue chip, so-called blue chip companies. And the first one is something distinctive. Usually we know it by brand. I mean, Coca-Cola, everybody knows Coke, and perhaps Pepsi. Then the second thing that you look for is a management team, and not one that's rested on its laurels, but you talked about the changes that faced, and e-commerce is one of the huge changes facing business today. So what is that management team doing with today's challenge, not necessarily just yesterday's? And then the last thing, which I think separates blue chip from today's fad, is a resilience, something that, a quality that characterizes this particular company that's taken it through lots of changes in the past, and perhaps will take it through tomorrow's changes. So those are the 3 things that we look for in trying to define blue chips.
And Roger, does that gel with how you would define it, or are there differences there?
No, of course, Bob, that's exactly right. I think I would say that also implies large. Usually you need to be large and you need to be quality, have a fairly good balance sheet, and probably been around for a while, too.
So a track record.
A track record, right.
Judy's nodding in agreement.
Right. I start with just the largest stocks in the S&P 500, maybe that top quartile. And if they're the industry leader, that's sort of a simple way to begin to look at a blue chip stock.
And Fritz, now, Judy, you said the S&P 500. A lot of people think of blue chips as simply the Dow 30. Fritz, do you consider that outside the Dow 30 as well when you're looking at a stock?
Our prospectus defines blue chips as being companies in the Standard & Poor's 500 or the Dow Jones 30 Industrials, and the same stocks in the Dow Jones 30 Industrials are in the Standard & Poor's 500, and we need to have 65% of the portfolio be in those blue chip stocks.
Now, as we go forward, there are more and more companies that are obviously growing, and there are more and more companies that are changing their mandate and how they do business. Bob, what do you look for when you're looking at a stock that perhaps is on its way to becoming one of those blue chips? What are your key requirements in a stock?
Well, to go back to the three things that I referred to, something distinctive in the service and product. You know, a brand is something everybody can easily relate to, but it's very hard to be a newcomer and displace somebody that is known for a particular category. So that's the first thing that we'll look for. One of the challenges to all of us, though, if you go back to the S&P 500 and look at the companies today that are usually numbered as a blue chip, they weren't around 20 years ago. Nobody heard of Microsoft or Intel 20 years ago. Today, they're household names. So one of the challenges to all of us is to keep a look at today's large companies. And large doesn't always win. You know, some of us remember IBM in the 70s that stumbled and fell. So large, matter of fact, large can sometimes work against you because you're not nimble enough for today's and tomorrow's changes. So that distinctive product, but usually what drives the outstanding companies is a management team that is innovative, willing to make changes. Intel made huge business model changes and may have to face those again. If the power starts moving to the net, Intel is going to have another business model challenge. So it's that innovative management team, I think, that sets apart everything else. We all know who is successful today, but who's successful tomorrow is a completely different story.
And you know, I think that's evidenced by the move that we've seen in some of the internet stocks, which seem to have taken all of the limelight away from some of the blue chip stocks. And in essence, that has triggered kind of a stumble, if you will, as we said earlier, in the blue chips. Roger, do you think we're going to see more blue chips in favor, given the fact that we're now starting to see some retrenchment and some profit-taking in the internet?
Perhaps we should go back one step on this blue chip thing. Blue chip means quality and all of the things that you've heard on the panel, but I'm thinking growth. And I think maybe you've implied that blue chip means growing company. A lot of blue chips are not growing, and those are ones I think we'd all avoid. But for the large, in fact, many of the cyclicals are blue chips, and they are really having their day in the sun right now. So if we're talking about the growth companies, they are taking a little break, but you can't hold a good growth company down very long.
Would you agree, Judy?
Yes, I would, but you can see the market rotating into the basic industry stocks and some of the stocks that have been such laggard. And as fund managers, I think we all want to pick up on that and be in there on the early so we can catch some of those gains. We may not stay that long, but a definite rotation going on now out of those traditional solid names.
Yeah, Fritz, do you think that this rotation that we've seen into the cyclicals, which has been the latest move, is going to last, or do you think it's a blip?
I think it's more of a blip in here. They've already had a decent move. In many cases, they can continue to do well for a while. Typically, cyclical stocks do very, very well coming out of a U.S. recession where most of their products are sold. And of course, we haven't had that. They're moving now based on a pickup in worldwide economies, such as we're seeing overseas. And it makes sense. And also, the big growth stocks that we've all done so well in have paused for a little bit, creating another buying opportunity. But a lot of these cyclical stocks are already at fairly high valuations. For example, International Paper is one of the leading companies in their area. They have the problems that cyclical companies do in terms of pricing pressure, not particularly great internal growth. But that stock on roughly $1 worth of earnings is $55 right now. And let's say peak earnings could be about $3. They haven't really earned a lot more than that. And so we're about 17 times peak earnings right now on the stock. Now, they're in phase and they could continue to do well for a while. But I prefer to look at a lot of these corrections in the high-quality growth stocks as here's just another buying opportunity like the last 100 we've had over the years. And take your eye off of Microsoft at 77 has come down from 92.
True. All right, we'll take a quick break, and then when we come back, we'll take a look at some of the most well-known blue chips and see whether they still belong in your portfolio. So don't go away. Back in a minute. Welcome back to a special hour of special coverage of the Los Angeles Times Investment Strategies Conference. I'm Sue Herrera, and I'm joined once again by 4 blue chip money managers: Robert Bissell of Wells Capital Management, Roger Engelman from the Phoenix Engelman Funds, Judy Jones of Key Asset Management, and once again on the end, last but certainly not least, Fritz Reynolds, manager of the Reynolds Blue Chip Growth Fund. We're here to give you some advice on buying blue chip stocks. And ladies and gentlemen, when I was looking at some of your top holdings, there wasn't a lot of overlap among all of you, with the exception of a couple of technology stocks. Give us your top 3 picks in blue chips.
Our top 3 picks in blue chips would be American Home Products, drug company, global drug company, General Electric.
Parent company of this network.
Parent company of the network. And Household International in the consumer finance business.
Roger?
Okay, our top 3 would be MCI WorldCom. Number 2 is Cisco, and number 3 is Pfizer.
So you're across a lot of different groups. So Pfizer was last?
Well, it's the last of our top 3.
Okay. Judy, what do you like now?
My top 3 picks would
Top 3 picks.
Boeing, General Mills, and a conservative pick for a value manager, Duke Energy.
Why Duke Energy? Because a lot of people don't like the energy stocks.
No, well, it's not really. It's really more an electric utility. I'm sort of conservative about the market at this point. Duke Energy has a 3.8% yield. We see about 7 or 8% growth rate for the company in the next couple of years. That might be the market's growth rate. And the PE is a fraction of the market's PE.
All right. You left me an opening on the market in just a second, but I want to get Fritz. What are your top 3?
We typically like to be positioned in the growth industries for the next 5 or 10 years. Those should be technology, retailing, health, which is 14% of the economy, and the demographics are an aging population, leisure time. So as a result, in the technology area, Microsoft, in the retailing area, Walmart, and in the health area, Merck and Pfizer.
All right, Judy, you said you're conservative about the market or slightly concerned about the market, which is why you went in to Duke Energy and the utility app. What is it that bothers you about the market?
Well, the multiples, the PE now is about 28 times. We've had 4 fantastic years of 30 plus, and then 20 plus, and then 30 plus, and then 20 plus. I think it's time to have a little caution and just sort of step back a little bit.
Does anyone feel the same way?
So I don't think I can recall a period in the last 25 years when it was a great time to invest in the market. People are always worried about market valuations, and yes, they're high today, but look at interest rates. We would argue interest rates are going to go lower. And if you think about it, PEs and rates move in opposite directions. Rates go down, PEs go up. So rather than to focus on the market, I think I would focus on individual companies and who's going to win. And I happen to think, even though companies have done pretty well in an earnings sense, they're going to do even better. And maybe we can talk a little later about the internet and impact on companies.
Well, corporate earnings have been a lot better this quarter than they thought they were. But is that because they were so dismal the previous quarter that our comparisons are all out of whack? What do you think, Roger?
Well, I think Bob is leading to something that I certainly agree with completely. I think America itself is making a new quantum growth spurt, big time.
In what way?
Well, for example, in my whole career, I've never seen really large companies growing fast. 20 years ago, fast would be 11% or 12%. Now, I could probably name 5 very huge companies growing 25 or 30% a year.
We'll get those from you in a little bit.
Yeah. And we have some dogs that are picking up their heels. AT&T. AT&T, in my opinion, was on their way to going bankrupt eventually. And all of a sudden, they got a new manager that's acting like a 13-year-old.
Michael Armstrong.
Hustling, and I think they're going to make it.
All right. What about you, Fritz? Look at the economy, look at the market right now, look at interest rates. I know you think they're going down, but the Fed has moved to a tightening bias anyway. Are you worried about where we are right now?
The last few years, the outlook has been almost ideal for investing, and it continues to be pretty ideal. That is a slow growth economy of 2 to 3 to 4% growth, low inflation, low interest rates at a 30-year low, a Federal Reserve that's fighting inflation out in front of the curve rather than kind of lagging behind. This continues to be a pretty good environment, I think, long-term for investing.
All right. You like healthcare,
Yes.
you said. You don't see a problem with the managed care situation? Some people say that that's still going to constrain growth. Obviously, you don't seem to think that.
Not as much. I think we're talking extremely strong fundamentals here. It's a very big part of the economy. I mentioned 14%. Studies have shown that there's 5 or 6 things that are most important to people in the United States or around the world, and one of them is health. As they say, the population is aging. Demographics are in their favor. And you notice a lot of these major drug companies are coming out with some pretty good breakthrough products. They're doing less Me Too research and more original type research. And even if once in a while a new product breakthrough is discovered by a very small company, they need the capital and the marketing of the larger companies, so they're more likely to do a joint venture with the larger companies.
Okay.
So the fundamentals remain very strong for those companies.
On that note, we're going to take another quick break, and then when we come back, we'll take a look at other blue chip stalwarts and see what place they might or might not have in your portfolio. So stay tuned. We're back in just a minute with more from the Investment Summit, the Los Angeles Times Investment Strategies Conference, right here on CNBC. Welcome back, everybody. We're continuing our discussion on blue chip stocks with our blue chip panel. Robert Bissell, Robert Engelman, Judy Jones, and Fritz Reynolds. Welcome back to all of you. There's one stock that everybody considered a blue chip, and it really has kind of fallen a bit, and that's Disney. Disney's had a... Ooh, I hear a rumble. Lots of people got Disney out there, don't they? It's had a little bit of a stumble recently, and others think that this is a perfect buying opportunity. Some think that Disney needs a makeover, if you will, that, you know, Mickey's seen his best days. Give me your opinions. We'll start with you.
So those are, we've seen this juncture before where Disney hits a earnings plateau, and it's clearly done that the last year and a half, 2 years. And you hear the same objections every time. But think about Disney and what it would take to replicate that kind of company. I don't know about your house, but ours is littered with Disney, and when the tape gets, you know, we're right back there to replace it. It's got one of the best franchises that I can think of. It is experiencing the headwinds on the earnings front. People criticize their film productivity. They wonder about the theme parks, that sort of thing. But these things are fixable, and I think this is one of the great opportunities to buy Disney.
Fritz, I think you also like Disney, don't you?
Yes. One thing that's worked for me over the years as an investment strategy is the concept of a key stock in an industry, and particularly in a strong industry, and that's the case. Disney is the key stock, or one of the two in the recreation leisure time industry. As we all know, they've kind of gone flat for a while here. But we do also know that when earnings come back, which they almost assuredly will, because if nothing else, they'll be going against easier comparisons a year from now in the next couple of years, they will, investors will be very interested in this stock. We are a buyer of Disney. We have been buying it in the last couple months or so, and it's still a smaller position for us, but I think it's attractive at these prices.
Judy, you've been nodding your head yes.
Well, actually, it's kind of an interesting example because our fund bought Disney back in 1997 in the low 20s, and they were having at that point some problems with ABC, and just the franchise was having some problems.
The football negotiations?
Right, and so we like to buy in when there's a little bit of a contrarian view. We actually sold out of the entire position at the beginning of this year, about in March or February or March, in the mid-30s. Now, I think the thing is you don't want to confuse a great company, which it is, with a great stock. And we just thought that the valuations had gotten ahead of us, and it was no surprise that the earnings, you know, there were several quarters there that the earnings were disappointments. So we got out, but we'll go back again, but because it is a great company.
Roger?
I'd like to be different.
Go right ahead. That's
But I
what this is
can't
all
because
about.
I can't though
Oh,
because
okay. I gave you an opening, Roger.
we've owned Disney for probably 15 years, and as Bob said, there's these little lumps that come along. This is the time that tests the long-term investor, whether you really are long-term or not. And when I talk about the internet train, really a train, it just sits there. I mean, it's worthless unless you put something in it. And Disney has the stuff that you put in that train. Disney is going to be really flying again.
You mentioned the long-term investor. How do you, it's changing what long-term is. I mean, yesterday Bill Miller was on the panel. Long-term for him is 10 years. For another gentleman who was sitting on the panel next to him, long-term was 1 year. You know, it really differs in this market especially. What's long-term for you?
Well, the first question is, are you a taxable investor or not? Because the worst thing you can do, especially with internet trading right now, is to go in and out and keep paying the tax man. It just gets prohibited. It just takes your compounded returns down to very dismal type of returns. But let's assume we're all tax-exempt investors. You're doing it in an IRA account or a 401k, that sort of thing. If you're trying to make the decisions underneath a year, good luck, because what invariably happens is you go from first choice, then you're looking at second choice because Disney maybe isn't quite got
There
the
yet,
oomph that a .com might have at the moment. So you're playing that game, and just watch out when the music stops because you may get burned.
And long-term for you, Roger?
Well, long-term is like blue chip. It means not tomorrow, you know, but way out there. Some company that you can have faith in. You talk about Disney getting, what did you say, he's getting ragged in the ears or something?
Mickey needs a makeover.
Oh, needs a makeover. Well, he's really stood the test of time. I mean, it's incredible, and he still is. And when you look at the Disney library, just as a minor little, for instance, they're going to put it all on DVD, you know, and I think, that, you know, don't worry about Disney.
So they're not goofy.
Yeah, they're not goofy, yeah.
I had to. It was just sitting there. Judy, how about you? What is your time frame when you buy into a blue chip?
We turn our fund over about 25% a year, so 4 years, basically. So that's pretty long term, I think. And when we do make a pick, Disney was maybe a little different example because that was an average holding period of a little under that, but about 4 years.
About 4 years. And Fritz?
The longer, the better. We strive to be very tax efficient.
Okay.
In fact, we're in the top 1% of all funds for tax efficiency. We have about a 5 to 10% turnover.
Terrific. We're going to take another break. We'll continue this discussion in just a second. We're going to start taking questions from our very large blue chip audience. So stay tuned. We have a lot more ahead on the Investment Summit right here on CNBC. And welcome back to our special program, the Investment Summit, the third annual LA Times Investment Strategies Conference. I'm Sue Herrera. And during this hour, we're asking our blue chip panel of money managers which blue chip stocks still belong in your portfolio. Here on the stage with me once again is Robert Bissell of the Premier Value Fund, Roger Engelman, manager of the Phoenix Engelman Nifty 50 Fund, Judy Jones of Key Asset Management, and Fritz Reynolds, manager of the Reynolds Blue Chip Growth Fund. Now, we have an enormous studio audience for today, and we are going to take some questions from the audience and get your opinions from our panel of what their questions are and whether or not some of these stocks belong in their portfolio. So we're going to start out right over here. What's your question?
Hi, I own AOL, and I also noticed that a couple of months ago, the #1 holding of the Phoenix Fund and the Reynolds Blue Chip Fund also was AOL. Now, AOL has a tangible book value of $0.25. It has an estimated earnings per share for 1999 for 37 cents. Its PE is not meaningful. Now, it was 165, now it's at 130. Is it a buy, is it a hold, or should I dump it?
All righty. Who wants AOL? Go ahead, Fred.
I think it's a hold right now. We are believers in the internet, and we think there's a lot of long-term growth there, and it's just the beginning. And you want to be a long-term investor in the companies that are best positioned. As you first come on the internet, it looks as though Microsoft, AOL, and Yahoo are the ones best positioned to get your eyeballs right away and then divert off to different places. So it's something you want to bet on long-term. So I'd hold on to your stock.
But if its growth is 50%, in 4 years, its earnings per share will be $1. That would give it a PE of 150 right now, or 130. Is it a logical buy?
Good point. I look at it in the context of a mutual fund or a large portfolio where you own a lot of different companies. And I think you can, for every Procter & Gamble or Colgate-Palmolive or Gillette you own that have been around for many, many years that are pretty dependable long-term food, beverage type companies, you can offset with that with some AOLs that, have higher valuations but far better growth prospects.
Okay, thank you, sir. Go ahead, sir.
Yeah, my question is about, you say the Pfizer is a good buy, Merck is a good buy. How about Warner Lambert? Their earning reports are good, their sales is up. Even their controversial medicine, Resolin, their sales is up. Still, the stock is going down.
Okay, who wants to handle Warner Lambert? Roger?
I'll take a crack at that. The CEO just the other day said that he thinks their earnings will grow 30% this year and 20% this year, which is really, really fast growth for a drug stock. We own it in our portfolio. I probably should have started with that. But all of the pharmaceutical stocks are way, way down from their peaks just because of this fear of government, interference with buying and price setting of drugs and all of that. But in the past, every time this type of situation has come up, those are fabulous buying opportunities. 1982 and 1992 or 93 were super opportunities, and I think you're kind of getting a mini one of those right now.
Would you add to your position?
Oh, yeah, I would, definitely.
All right. Thank you, sir, for your question. Let's go right over here. Go ahead, please.
I'd like to direct this to Mr. Reynolds. Recently, the network or the enterprise software sector has really been beaten down, particularly with their accounting problems, Network Associates, and then a few years ago, Informix. And I'm wondering if you think that in the near-term horizon that we might see an advance in that sector and in those two stocks particularly.
We haven't done much with those companies over time. There's a lot of technology companies out there that I think have better long-term growth prospects.
Such as?
Well, in addition to the technology ones we've talked about today, which I agree with those different ones, there's, in the telecommunications area, there's Lucent, there's Nokia in the cell phone area, and Motorola. In the computer peripheral area, there's IBM and Hewlett-Packard. So there's a good grouping of 8 or 9 really key technology stocks I think you want to bet on long-term. These companies kind of, rank much lower there in terms of quality. I don't know them very well. They may be speculative type buys in here, but I really can't comment on them.
Anybody else have an opinion on enterprise software before we move on?
So I'd like just to make a comment. In the context of blue chip, normally you have the advantage of looking at series of years of earnings stream. And when you get into the .com and the forefront of technology, you don't have that. As gentlemen pointed out earlier, the earnings are not there. So what people are trying to do is look out 10 years, guess the value of the franchise, and then discount that back. And which says there's going to be a couple of winners, but nobody knows if everybody wins. I don't think everybody wins. So it's a much higher risk path. You can't criticize it because somebody will win internet, but not everybody will. And so I would differentiate that from a blue chip and tomorrow's winner. I think they're two different discussions.
That's a good point. Let's take another question from right over here. Go ahead.
Hi. I want to thank the organizers for orchestrating a very excellent investments conference.
Oh, thank you.
My question is the prognosis for IBM, both short-term and long-term, and if you have specific price ranges.
We heard a little bit of IBM in the future, or in just the last couple of minutes from you, Fritz. Who else, and also from you, Roger? Anybody else want to weigh in on IBM?
Well, it is our largest holding, and actually we have been lightening up on it, just in recognition of the stock's performance. But long term, it probably will always be a significant holding in our portfolios, but we have been lightening up on it.
You're worried, what is it that bothers you?
Just the performance and the sort of the unanimous opinion by Wall Street that, this is the #1 winner. And we we're a little bit of a
You're
contrarian, and so we tend to lighten up at that point.
Go ahead, Fritz.
We own IBM. It's a large holding for us. We're holding it right now. It's been a tremendous turnaround, as you know. Now they're turning it into an internet-type stock with recent comments, and a lot of the sales are going over the internet. I think, like a lot of these blue chip companies, it's a great hold and a good buy on weakness.
Okay, we're going to take another quick break, and then we're going to take a lot more questions from our audience, so don't go away. We're back in a minute right here on CNBC. Welcome back to CNBC's special coverage of the Investment Summit, and we still have an awful lot of people in the audience here at the Los Angeles Convention Center with questions for our blue chip panel, so we're going to go right back to the audience. Go ahead.
Yes, I'm interested from the distinguished panelists, which blue chip stocks that don't cost, you know, 100 and up per share, maybe the less expensive per share blue chip costing stocks you might recommend.
Okay. Judy, why don't we start with you?
Well, actually, Boeing, I think, fits a perfect stock for that type of question. You know, it's relatively inexpensive. It has it's selling at less than 20 times earnings, and it has a respectable dividend yield of slightly more than the market's yield. So I guess Boeing would be one. If you're looking at strictly dollars, you're right. A lot of them have, you know, they're all topping over $100 a share, but Boeing at around 57 or so, that would fit the bill, I think. That would be my first pick.
Bob and then Roger.
Sue, one of the things to be careful of is the most expensive stocks I've ever bought personally have been the cheapest in price. And so cheap in price doesn't equal value per share. You know, so what I would say is look at the company that you're buying. You may end up with a few number of shares, but you can still put the same dollars to work in that particular company.
That's a good point. Roger, what are you watching right now?
These stocks are really cheap. You know, I mean, you could be buying Warren Buffett's company at $75,000 a share. But I would emphasize the value and not so much the price itself. I mean, I wouldn't worry about the number.
All right, let's go right over here, sir.
Yes, I own Tel Labs, and I have two concerns going forward. One is that much of their success seemingly has been based on products they've made for copper lines, copper telephone lines. What is their strategy going forward for the fiber optic market, A, and B? Is there any concern that Cisco and Lucent will steal some of their market share?
All right, well, Roger, you own Cisco.
Yeah, I own them all. As a matter of fact, and that's a very good question, I'll tell you that. But in fact, this leads into what we were hearing about just a minute ago. Tel Labs is up 75% this year, and was also big last year. So it's been a spectacular company. I will say the company itself thinks they'll be a $5 billion company in 3 years, which equates to a 30% compounded earnings growth between here and there. And yes, they are going to compete like crazy with Lucent, which we also own, and Cisco. But it's a very competitive world. You can't avoid competition. You just got to be as good as you can in your area. And they have a small niche, really. It's a cross-connect type products. But they're planning on doing well, whether it's cable or copper or whatever.
So he should hold his stock?
Oh yeah, we would definitely cross our fingers and hold the stock.
If it dips, would you buy more?
Well, it would have to.
Remember,
it would have to dip a lot. It's up 75% this year. I mean, just to give you an idea, we're long-term holders until that.
Okay, go ahead.
I agree with Roger on that. We also own it. It's a 1% position for us, and I'd hold it, but it needs to drop a bit for where we'd buy more.
Okay, go ahead, sir.
Yes, is there a formula that you use to determine whether or not a stock is good, of good quality?
What criteria they use for picking stocks? Well, we talked a little bit about that earlier. Why don't we continue that? Go ahead, Bob, you start.
Well, I think the question was, is there a formula? We'd all like to know what that formula is. It's a combination of formula and art, and part of it is quizzing management teams, understanding business strategy. There's no formula for that. That's a judgment. So
part of it's your gut.
Part of it's your gut. What the formula side gets to the price, you know, are you buying something at a reasonable price? And yes, there are all sorts of formulas for that. Price to book, price to sales, PE ratio, that sort of thing. There are multiple formulas. There are various systems that people have come up with through the years that give you a rough guideline, but that's all they are, is guidelines, I think.
Okay,
yeah,
and you
I
have
would say
something to add?
formulas can get you into trouble, too. If you really stuck to a standard PE, let's say the average PE in the market's 15 over a 30-year period or something, if you'd have said, well, I'll sell as soon as it gets there, you would have missed this last 3 or 4 incredibly great years. So you got to be careful about formulas in the first place, I think.
But that's different than not having an investment plan. In other words, a lot of people think that they need to devise a plan and stick with it. And you would differentiate that from a formula of looking at a stock.
Absolutely right.
Okay, Fritz?
The formula or method of valuation that works best for us is to do the PE ratio relative to the growth rate. If you think about it, all of these stocks have a PE ratio, but they have varying growth rates. If you just looked at the absolute PE ratio there, you'd always buy the Heinz ketchup at 13 times, and you'd never buy the Microsoft at 30 times. Currently, the companies that we own have a PE ratio relative to the growth rate of about 2 to 1. They vary between, say, 1.5 to 1 in some cases. Some of them are higher than 2 to 1. Then you have to take into consideration where we are in terms of inflation and interest rates, because when we are valuing stocks, we're discounting back a dollar's worth of earnings earned a few years from now to the present time. And the higher the interest rates, the less that dollar is worth, with underlying inflation being higher. Currently, with interest rates at a 30-year low, a ratio, I believe, of 2 to 1 is a good valuation on these companies, and a fair one, and long-term they're attractive.
Okay, let's go right over here. Sir?
Hi, my question's for Roger concerning Pfizer. First, I'd like to ask Ms. Judy Jones to say hi to one of her colleagues, another Jones at Key Asset Management, Ron Jones, who you may know. Yeah, he's doing a fine job there, and he's a good friend of mine, and he's great. But anyways.
And the check's in the mail.
For you, Ron. No.
What's your question?
Roger, with Pfizer, getting ready to go through its 3-for-1 stock split, it seems that maybe about a month or so ago, the fund managers may have been lining themselves up and dumping, selling some of Pfizer's stock, and we went from that 150 to 115 or so. That is what, you know, the layman out is looking at. Do you credit the government regulations coming down on the drug industry, or are you guys selling and then after the split looking to pick more up as it bounces?
What do you think, Roger?
Wait, no, we're holders. We believe Pfizer is one of the great long-term companies. They spend several $1 billion a year on research, trying to create new drugs, and they have what they call a very nice pipeline of things that are in the pipe and ready to come out. I'd say there's 2 reasons Pfizer's down. One is it was expensive. It's still expensive, actually. It's by far the highest PE of the drug companies. But 2, the government is, we're not sure exactly what the government is doing, but what the government just says, we're thinking of something, down go the drug stocks. So, no, I don't think there's been selling anticipation of splits or anything like that. It's just the fear, you know, plus they've been such spectacular winners over the last years. So if you're a holder of Pfizer, I would just relax and enjoy it.
Okay. We're going to take one last break, but when we come back, we're going to take more questions, of course, and ask each one of our managers if they had to pick one stock to put in your portfolio, which one would it be? Back in a minute. Welcome back to the Investment Summit, our blue chip panel of money managers. You know them by now, but we'll go over them again. Robert Bissell, Roger Engelman, Judy Jones, and Fritz Reynolds. And we're trying to grill them a little bit. Not too much, though. And the studio audience has some questions as well, so we're going to get back to the audience because they've had some terrific questions today. And we'll start out over here. Go ahead, sir.
I was curious about the valuation of Philip Morris and its various businesses, and also if you guys utilize dividend reinvestment in your mutual funds.
Okay, Philip Morris, and then the second question was dividend reinvestment. Who wants to handle Philip Morris? Roger?
I'm not sure I want to, but...
Okay. You raised your hand, though.
Yeah, I raised my hand. Philip Morris has been a very intriguing situation. We've owned it for about 15 years. And finally threw in the towel, to tell you the truth. Just tired of explaining it to everybody, and tired of, the public is so incredibly down on the company, and their lawsuits, I think, are going to continue and continue and continue. And even though it may work out, it probably will work out. You know, they have about a 3.8% yield now, and they still have, you know, huge parts of their business is the largest food, you know, seller in the country as well. That it probably will work out, but I'm just tired of it, you know, and we can put money other places.
And there are a lot of other stocks to buy?
There's other things we can buy.
All right, let's go over here. Sir?
At the beginning of this panel, Bob and Roger seemed to emphasize that one of the key factors in identifying a blue chip company was strong management. How would the ordinary investor identify that kind of strong management as a company may be becoming a blue chip stock?
Okay, how do you evaluate a fund manager?
Very simple. You look 20 years ahead and see how they did.
Go ahead, Bob.
So just a point, I think what is terrific about what's going on is both with the internet and CNBC is the investor has access to a whole lot more information today. You can listen to a CEO being interviewed on a network and listen to what they say. And the questions, you know, tend to be, what is your strategy? And if they cannot articulate their strategy, I bet they can't implement it.
Our marketing department loves you. Gave us a great plug. Thanks, Bob. Let's go over here for another question.
In the Dow run-up from 5,000 to 10,000, I noticed that the worst performer in the 30 Dow Industrials was Eastman Kodak. How does the panel feel about Eastman Kodak at this time and into the future?
Judy, do you own it?
No, we don't, and we haven't. Part of the trick of performance has been not to own some of these stocks, and when I looked to see how many of the Dow stocks we actually own in a blue chip type fund that I manage. We only own 12 of them, and Eastman Kodak is not one of them.
What is it that bothers you about it?
Just their competitive edge versus some of their more, the international competitors. We just don't think they've lost their leadership.
Okay.
So we just weren't interested.
Let's go over here. Sir, go ahead.
Yeah, my question is directed at Fritz here. And he said he owns 1% of Amazon or AOL and things like that. You know, we in this audience here, you know, don't have billions of dollars under investment under each of us. You know, we have less money to invest. I'm asking the question of market capitalization. We as blue chip money managers, if we use market capitalization as the parameter to evaluate companies, we tend to drive the values of these stocks high, and that's a very high risk approach, you know, of doing things to individuals. That's why I'm asking.
Fritz?
I wasn't sure.
Basically, I think you want to know why, given the market cap of AOL, he owns it.
Yeah, how can it be propagated as a blue chip stock? Because
I think, as I mentioned before, I think that the internet is one of the most exciting industries that's come along in the last 30 or 40 years or so. So we want to participate in the growth of the internet. Most of our participation is from the companies that we would own anyway, such as Microsoft and Cisco and Lucent that we talked about. This is maybe one of the exceptions, a newer company. It does have 17 million subscribers, and we think there's going to be a lot of growth there down the road. But I agree with what you're saying. I think what you're getting at is that we do not want to have America Online just as one of 8 stocks in the portfolio, but in a well-diversified portfolio, it does fit in.
Okay, now we promised the one pick that everybody should have in their portfolio. No pressure. Go ahead, Bob.
Well, going back to my opening statements about brand name and emphasizing the management part, I would tell the audience that the first thing, when you pick your own stock, is make sure you have confidence in the brand and make sure you have confidence in the management team. I'd pick Household International. I think Bill Aldinger's a terrific manager.
Very quickly, Roger.
I could own just one for a long time, 5 or 10 years. I'd pick Pfizer.
Okay. Judy?
One stock, Boeing. I think the
Boeing.
restructuring.
Fritz?
I'd pick Microsoft.
Okay, on that note, thank you all very much. We've run out of time for this hour of our special program, the Investment Summit. Thanks so much for joining us here at CNBC. We want to thank our panelists very much and thank our studio audience. We really appreciate it. Bye-bye.
Hello again, and welcome to this hour of our special program, the Investment Summit, the 3rd Annual Los Angeles Times Investment Strategies Conference. I'm Maria Bartiromo. During this hour, we are going high-tech. Everyone's been talking about and investing in technology stocks, especially the Internet. And for the most part, they've gotten spectacular returns. Stocks like AOL, which shot up 587% last year, Amazon.com, which skyrocketed 966% last year. Internet stocks as a whole, in fact, are up more than 60% so far this year. But some of the high flyers are beginning to get hit. So what place does high-tech have in your portfolio now? Joining me today to tackle that tech sector, Alan Harris. He's a co-manager of the Munder Net Fund in Michigan. The fund has a one-year return of 137%. Next to him, Kevin Landis, co-founder of the First Hand Funds in San Jose, California. His First Hand Tech Value Fund has a 5-year average annual return of more than 44.5%. And on the end is Andrea Williams, consumer internet analyst for Volpe Brown Whalen in San Francisco. Welcome to all of you.
Thank you.
Kevin, let me begin with you. Internet stocks in particular have been spoken about so much recently, and technology certainly has been a great place to invest. How much do you think an average person's portfolio should be invested in technology?
I think that depends on not so much your risk tolerance, but your tolerance to volatility. Whatever money you put in high tech is going to be launched on a roller coaster that'll trend up over time, an excellent one, but one that's going to try your discipline and your self-control.
So should you be deciding that based on your age? In other words, the younger you are, the more risk you may want to take on and invest in technology?
Generally speaking, yes, but really, time horizon is not exactly about age. For example, if you're saving up money for the down payment on your first house, you're not a long-term investor for that money, but for your retirement you are. If you're saving money for your kid's college education and the kid's 12, well, that's a 6-year time horizon, we hope, and if he's 15, well, maybe that shouldn't be in tech.
Alan, what about you? Your Net Fund focuses on the Internet, obviously, but you have other funds which you also oversee. What do you think? How much of a person's portfolio should be in technology?
Yeah, we feel like approximately 20 to 25% of a person's portfolio should be in technology for a couple reasons. That's usually about how much is in a growth stock investor's index. And second of all, the importance of technology in the overall economy. According to the government, technology lowers inflation by 1 percentage point a year. And about 50% of all capital expenditures now by corporations throughout the country are on technology. So technology is a very important consideration in the growth of the economy, the productivity in the economy, and we feel about 20 to 25% of a person's portfolio is about the right mix.
Andrea, you focus on the Internet, and we are going to get into the Internet a lot later on in this program. But let me ask you, is there another area that you could be investing in that perhaps gives you a window of opportunity into the Internet, but is not necessarily the pure play Internet companies that we all hear so much about?
I think on the hardware side, there's probably some interesting opportunities. We tend to focus on personal computers when we think of internet access, and PC prices are coming down, and we're seeing a broadening of the penetration there. But we will see over the next several years a proliferation of other types of internet access devices. People will be accessing the internet through their cell phones, through their Palm Pilots, and that's going to, I think, really spur a second wave of accelerated growth in internet access, and I think there's some interesting opportunities in that area.
Oh, we definitely want to get into that. Let me ask you, though, Kevin, about the PC sector. Throughout much of the 80s, the PC stocks were considered the growth stocks, the big high flyers, if you will. But recently, we have seen some of these stocks take a hit. Do you think that there is really a slowdown happening in the PC sector, and should we be staying away from stocks like Dell, Compaq, Hewlett?
Well, I think one of the biggest favors we did for ourselves was to stay away from PC stocks for the last 5 years. We haven't owned a PC stock since we've opened the funds, and the reason is that although in terms of units, the market continues to grow, the average selling price comes down, the business just gets more and more competitive, more vicious, and it's an ongoing retrenchment process. High-tech really isn't about the PC anymore. It's about how you connect them.
So it's really become commoditized?
Very much so, yes.
Do you agree?
PC is definitely a commodity business. The difficulties in PC stocks recently has a lot to do with the results that Compaq has exhibited, which are not very good. Basically, they have a distribution problem. Most of their PCs are sold through retailers throughout the country as opposed to direct like Dell does. The sector has been brought down a lot on what is going on at Compaq and the management difficulties there.
Let me ask you what I asked Andrea, and that is, do you have any specific companies that you like away from the internet or the pure play internet sector?
Within general technology, we think a great theme out there is telecommunications. MCI WorldCom, for instance, is one of our favorite holdings. They are best positioned not only in overall telecommunications, but particularly for the internet through their UUNet subsidiary, which is the best backbone for internet access, distribution, and corporate data. And they're growing cash flow at 30 or 40% a year, which is pretty significant, as big of a company as that is.
So it's really all about accessing the internet, somewhat of like the build-out companies. It's associated with the internet, but not the pure play internet stocks.
Exactly. The internet has to do with a lot of different factors. Access is one of them, and so the telecommunications companies fit in very well in the growth of the overall internet, but are really technology companies as opposed to pure play internet companies.
Kevin, you mentioned the telecom sector as well.
Right. You know, the way I look at it is this. If you get on the Yahoo conference call and you hear that their page views went up, more people are clicking their mice on the Yahoo site. That's great. It means more traffic. That means more bits flying over the wires of UUNet, which means UUNet has to grow. Now, UUNet's probably not as richly priced as Yahoo, but why not dig a little further? UUNet has to expand. Where do they spend the money? Cisco, Lucent. Follow that trail and keep going. Keep following the money. And actually what we found is the suppliers to the Lucents and the Ciscos actually are growing faster and have lower price earnings multiples. So those have been some of our best investments.
Okay, we're going to take a quick break. We have to take a short break, but when we return, we'll look at the best ways to play the internet sector. Stay tuned for much more of our special coverage of the LA Times Investment Strategies Conference right here on CNBC.